Inflation back to anywhere near back to target here.
No.
So that's a potential risk for the BOE.
I think it's something that they're going to have to manage. In terms of the equity starts of trade here in Europe, I don't think you're going to see very much. I think it's going to come later on this week. Keep an eye on what happens with the China story. Maybe there's a downgrading of expectations there after the press conference was cancelled. But I think it's going to be very marginal differences in terms of the index levels. But we'll see what happens in terms of the individual movers and what is going to be happening here. Markets are now opening across Europe. FTSE 100 looks like it's out of the gate, slightly negative. I think you're probably going to see pluses and minuses across Europe in terms of the index story this morning. You have seen a tech story coming out of Asia as well. ASML could be a theme there. TSMC, I think, hitting a record overnight. But the early action in terms of the percentage gains, discerning is up. In terms of the percentage story, Novo Nordisk is up by 1.7. ASML, in terms of the points gain, is the biggest gainer, up by 1.6%.
From a index contribution level, you're already seeing healthcare kind of come out of the gates swinging here. You've got GSK coming out. You've got AstraZeneca as one of your biggest kind of weights to the upside. We call it weights, lifts to the upside. On the downside, though, you're seeing a couple of these banks and the commodities names, and I think Tom had mentioned this earlier, that some of the miners might be under pressure as well. You were seeing a similar story. Glencore, for example, Rio Tinto. And then, like I said, some of the banks are really taking it down. Lloyd's, for example, Barclays, HSBC. Those are your biggest weights on the FTSE 100.
So LVMH is adding to the downside when it comes to the Stock 600. It's the biggest weights points drop. But Ferrari is down as well. So Ferrari's down by 2.5%. Citi out with the note this morning on Ferrari. Downgrade there, which is interesting because it's Ferrari. Beata Manthi was here from Citi a few days ago. She's got this kind of whole Super 7 stick, which is her response to what's happening with the Magnificent 7. And Ferrari's on that. So Ferrari is soft this morning on the back of, amazingly, a Citi downgrade. So there's some softness in luxury.
It's not part of the granola mix, is it? That was put together, of course, by Goldman. Part of the granola mix is ASML, and that you suggested they were going to get out, and they are. Is gaining, of course, on the back of the gains that we saw. Toast TSMC, of course, the producer of the chips with the foundries in Taiwan, as you said, hitting a fresh record. ASML, the maker of these ultraviolet lithography machines, also doing very well again. And again,
SAP's
part of that granola basket. Yeah. SAP is also part of that granola basket.
Yeah. So the tech is up. Luxury looks a little bit soft. Banks are a little bit softer as well, certainly. So you've got the main tech names are down. LVMH, Ferrari, Immerse. You've got Richemont soft as well this morning. Kuehne Nagel continues to drop after the big drop that it saw Friday. Yeah. On the upside, it does look like a tech story. Some of the commodity stocks are higher, so Shell is rising a little bit as well this morning. Some of the healthcare stocks, Astra and Sanofi. But basically, the big story is, in terms of the weight, is luxury down, tech up.
And the fact that we're talking about healthcare up higher as well, we're still waiting for the German index, the DAX, to open up. But Bayer is going to be one that I really have my eye on. They're reporting earnings tomorrow. Over the weekend, not only did they win a court case in Arkansas, which actually helped with some of their one of the legal suits that they had going, but they also got exclusive European marketing rights for their new cardiology drug. That was a potential pain point for the company as well. And again, how much do you position ahead of the earnings story coming out tomorrow?
So things are happening today. Not many, but things are happening today. The market's fairly becalmed. You can see ASML is up quite nicely. Lufthansa is down by 0.7%. In terms of the week ahead, we're looking at a fairly quiet day. We've got Holtzman on the list, I think, which is interesting, because I don't think he's actually allowed to say anything today because he's in a quiet period ahead. But that kind of speaks to the fact that maybe actually today is going to be very quiet. And then we've got, as you say, there's lots coming up. NPC is out of China. You've got Powell speaking on the Hill midweek. ECB rate decision, Lufthansa earnings. And then the one I'm actually going to be watching out for, because I think it's going to bookend the week, is going to be the payroll story on Friday. But I think Powell is going to be really interesting, only because the market is on the pivot point, I would argue, of going from pricing 3 cuts this year to potentially pricing 2 cuts this year.
Well, you've already seen that kind of volatility show up in the markets, and I think it's almost, on the one hand, it's okay, well, the markets are actually perhaps hearing Powell's message. On the other hand, does any bond trader know what they're doing right now? That kind of seems like the other side of the coin that I'm hearing.
Did the Democrats haul him over the coals? And, the run up to the vote, why are you not cutting sooner? Offset any potential downside across this economy, keep the growth going. Do you expect him to be grilled by the Democrats? Can they score any points? Does it matter?
The highlight in the Senate is always Elizabeth Warren. So
I
would expect Elizabeth Warren to be pushing him pretty hard.
Well, she has already kind of been very tough on his case in terms of saying this is a man who's going to tip us into recession. He's going to kind of hurt the working families of America, et cetera. But that's 100% correct. And he's walking a very fine line. The further and further back you push rate cuts, the further and further back you run the risk of looking like you're partial on an election front. At the end of the day, James Carville, the strategist behind so many presidents, because that is the economy's stupid. So if you start to kind of boost the stock market around the election, boost the economy in some way, suddenly does Biden have an edge, accidentally or not, from Chair Powell? And I am in no way suggesting that Chair Powell has any sort of political bias.
Is it the economy stupid, though? Because all the data is suggesting that this is a strong US economy, and yet when you poll and you look at the polls, people feel pretty miserable and they feel pretty downcast about their prospects in the US. There's a disconnect between how people feel and what the data is telling us.
Well, people like to look at bigger numbers in their paycheck, and I think the stickiness of having to pay extra for groceries sticks around. It's not one that you just look at and say, well, technically my real wages are higher. Well, yeah, but you're still making not as much as you were making 2-3 years ago.
Mark was dissing the University of Michigan data, but one of the key things that has come out of the UMich data recently has been that consumer expectations rise and fall with what is happening in inflation expectations. So inflation expectations start to get dampened, consumer expectations rise. But I think we are going to see potentially Elizabeth Warren pushing back, saying you need to be cutting rates. But there is a growing consensus in the market that maybe actually we don't get any rate cuts at all. The possibility of even hikes being talked about. Torsten Slock was talking about this on Friday, had a note out saying we are probably unlikely to see rate cuts this year. He elaborated on what he had to say in the notes with the surveillance team a little bit later on in the day. Take a listen to what he had to say.
The market now has to realize that the data is just not slowing down, and the Fed pivot has given an additional tailwind to the economy and to financial markets and financial conditions and to capital markets. And all that is likely to continue to be supporting growth in consumer spending, in CapEx spending, in hiring for most likely the better part of this year.
Joining us now, Laura Cooper, Senior Macro Investment Strategist over at BlackRock. Laura, pleasure to have you on the program. Walk us through this narrative here. What is the case for no rate cuts at all?
I think the case for no rate cuts is just the Fed sticking to this data-dependent approach. And if we start to see, economic data continue to surprise to the upside, really underpins this resiliency type of story. I mean, I would push back that we're not going to see any rate cuts this year. I think if we start to see some of the leading economic gauges does suggest the consumer is coming under pressure. I think we're going to have to see a degree of maintenance cuts to prevent those real rates from rising further. And essentially, that could curb a soft landing entirely. So I think it's a very nuanced type of approach that the Fed has to try to tackle later this year.
But how do you trade it? Going into even just payrolls on Friday and the ECB less than 24 hours prior, what is the trade?
I think there's probably 2 ways of looking at it. One is we've been sitting out in front-end exposures in the U.S. We still think, that's the opportunistic play, given, we don't want to take on duration because there's this kind of growth uncertainty. But the second, probably most interesting factor is just how resilient equity markets have been on the back of this rates repricing. And I think investors have focused from the rate story more to the growth story. And the question is, can that actually be sustained, particularly when we start to see greater dispersion in that Magnificent Seven? Can that momentum persist?
You use the word resilience, and this is an equity market that you could describe in many other words. Maybe one of them is a bubble. There is a lively debate now, and the front page of The Economist kind of points us in that direction. Journals talking about it today. John Authors here at Bloomberg's talking about it today. How do we know if we're in a bubble? Do you think we're there yet? Does this feel euphoric?
I mean, I don't think necessarily that we are in a bubble looking at broad equity markets. I mean, yes, we're certainly seeing this narrow breadth, this concentration within the Magnificent Seven. Valuations are stretched there. But from an earnings perspective, Q4 earnings, they were, able to beat or, meet those elevated expectations. Looking further out, these are the companies that are going to be profitable. The key question is, are we going to see this kind of expansion of that gains across different sectors? And I think we've yet to see that. And that's really kind of the key catalyst that I would watch for, to have greater conviction that this is a rally that can be sustained.
Okay, let's come at it from another angle. At some point, we are going to see the market taking a dip. Now, we don't know how long that dip is going to last. We don't know what magnitude it's going to look like. But at some point, very few things go in a straight line for very long in markets. So at some point, we're going to get a correction. You get a correction. When do you know when to buy the dip? Is that correction going to be pulling in a lot of money out of money market accounts? How do I play a dip when it comes?
Well, I don't think it's quite clear that we're going to see a significant drawdown from here. I mean, what's the catalyst for that? It's really hard to see that given the economic backdrop. And if we kind of take a step back and look at the earnings picture, if we look at some of those cyclical sectors in the U.S., in Q3 and Q4 of 2024, those expectations are actually set to outpace what we're seeing from tech. So we could actually just see this broad rotation beneath the surface within overall U.S. equities, rather than kind of this catalyst that could prompt this sharp drawdown.
What's the catalyst then for Europe? And do you want to? At what point do you want to think about upping your exposure to Europe if you haven't done already? What would the key points be for that? It's a market that is not performing on the earnings front. It's not matching, obviously, what we're seeing in the US or indeed Japan.
And this is a great question. I think we certainly are warming up to European equities. If we look at a lot of those forward-looking leading gauges, it does suggest that economic activity has troughed. We are continuing to see this disinflationary trend persist. The ECB is poised to cut rates by June of this year. The key thing that we're watching for is negotiated wages at the end of April, just to signify that they are actually seeing that easing in wages. We're already starting to see that play out in equity markets. Certainly those cyclical sectors like industrials, consumer discretionary led the rally in February, whereas defensives were a bit on the back foot. Probably a bit too premature to kind of go all in on those cyclical exposures. And we're still looking really for that quality tilt. Because if we think about what's kind of the supports in European equities, it's healthcare, it's looking at what we're seeing in luxury, and as well as semiconductors. So quality captures about a third of those different stocks. So that's the way we want to play right now.
If, and it remains a big if China's policy response comes out more aggressive and more focused than maybe some are expecting, if China's able to revive that economy and that sentiment, how do you play that from a European perspective?
I mean, at that point, maybe you could take on more of that industrial type of tilt, given the kind of the export-oriented nature of the German DAX in particular. I mean, we're kind of playing it more from a periphery angle, because if we look at what's really driven the European growth backdrop, it's come from Italy, it's come from Spain. So we think, Italian banks have outperformed. Maybe that's kind of reached a bit of its limit, but I do think, overall, that trend can still persist, particularly in the rates market as well. We want to kind of take on more of that periphery rates exposure, given this different dynamic.
Credit, it's really interesting because this week kind of, you do wonder whether this is the transition week. We've been very obsessed with central banks recently and what's been happening with the rate story, but actually this could be the week when politics really starts to manifest itself in a big way. Like we've been talking about Trump maybe taking the gloves off after Super Tuesday, but you've got the NPC as well as a factor in there. Like you do wonder whether we've got a kind of almost changing of the guard week this week in terms of what's going to be the market driver.
Yeah, and I would argue the UK budget falls under that kind of umbrella as well. For me, it's the trade story, 100%, because you're talking about these kind of sectoral stories like healthcare, like luxury that Laura was just talking about. These are all arenas that could change in the next 12 months or so. Massively. Regulation, tariffs, auto tariffs, incentives, dividends, the Inflation Reduction Act, you name it. Laura, where do you even start to price this in? Is this something you price in at this point?
I mean, it's probably a bit too premature to price that in. I think, markets are going to be sensitive to headlines around this. But I think overall, if we take a step back, thinking around this potential isolationist narrative, this end of rapid globalization, that ultimately underpins our view that we are in this new inflation regime. So it does suggest that even as central banks start to cut rates the middle of this year, thinking about the Fed, ECB, we are still going to be in an environment where inflation is probably going to settle at levels above that 2% target. And it's really about the profile. We could actually see a resumption of inflationary pressures later this year.
But
so that's a key risk.
How do you play? stock selection becomes really interesting at this point.
Yeah.
The past Trump administration targeted European luxury as a way of it saw it as a pain point for Europe. You look at the names that have done well out of Europe. I was talking to Beata Manthi from Citi about this the other day. You look at it, Ferrari's done really well. Hermes has done really well. LVMH has done really well. Those have got to be, like, if Robert Lighthizer is thinking about where he's going to kind of hurt Europe, those have got to be areas that he's got to be looking at right now. Do I need to front run that? Do I need to think about that as I look at some of those stocks that have done so well in Europe? And the tightness here in Europe, the concentration in Europe, is almost as great as it is in the States.
And I think that's why we're advocating for this kind of diversification approach, looking across developed market equities. So you want to take on some European exposures in some of those areas that, yes, they're vulnerable to the potential kind of trade backdrop, but we think valuations are attractive. But it's about seeking exposures elsewhere, so Japan or EMX China. We think there's a lot of attractive opportunities in this backdrop, particularly if we do see the soft landing narrative come through in the U.S. and the kind of the geopolitics could really just stay at the margin.
Beyond equities, what's looking attractive to you at this point?
I mean, so we just closed our underweight on U.S. equities. We think the tech leadership can continue to persist, even if we start to see some of the momentum fade there, and as well taking on just that quality tilt within Europe. I mean, cyclical is probably not yet at this juncture, just because we think, yes, growth is showing signs of improving, but probably not enough to add conviction. That, I think, is really dependent on the ECB and whether we actually see kind of this hawkish rhetoric start to fade, whether we start to see them actually discuss rate cuts, and that kind of ease in financial conditions we think could really provide that next catalyst for overall European equities.
Okay, Laura Cooper, thank you very much indeed for joining us in the studio to kick things off, of course, on a very, very busy week for these markets with a deep dive across many of those things. BlackRock Senior Macro Investment Strategist Laura Cooper, thank you. Coming up, UK Chancellor Jeremy Hunt, we've been discussing this, announcing, of course, new manufacturing funding ahead of his budget on Wednesday. We're going to preview his big speech. That is next. Plus, later this hour, we're going to speak to Ben Way, the group head at Macquarie Asset Management, and Paul Schroeder, Chief Executive at Australian Super, Australia's biggest pension fund. Stay with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in. I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We're 20 minutes into the European equity market session. It is exciting out there. Certainly at an index level, it's all happening. It's really not. FTSE 100 is down by 0.2%. The CAC is down by 0.1%. The DAX is having a very good morning. It's up by 0.01%. So, yeah, I think quiet starts this Monday. And then it's going to ramp up.
Come on, Guy.
No,
the Nikkei smashing past 40,000, 16 straight weeks of gains across the global benchmark. After the last 18, we're punching through fresh records. Bank of America's upgraded their forecast for the S&P to 5,400.
There's the excitement we need.
Guy.
So why is it not translating into Europe?
Yeah, okay, we will. Give us a Pretty, help me out.
I refuse to. I'm just gonna. I think the perfect segue here is to go to our very own Lizzie Burden. She's on the move with some of the individual stocks. Lizzie, walk us through it.
Yeah, the Stoxx 600 this morning, Critty, is flat to the upside. I'll settle it for you there. But it is a strong start, at least for European tech. Higher 0.6% as a sector this morning, catching some of the wind from Friday. The Nasdaq, of course, up 1.4%. But bottom of the basket this morning, consumer products and services, luxury taking a bit of a beating. So if we dive in a bit more deeply into some of the individual stocks on the move at the open, one of the tech gainers is ASML, higher 1.5%. You also got Diasorin, one of the biggest gainers on the Stoxx 600 this morning. This is after the FDA gave approval for its Liaison Plex system. It's up its most in 11 weeks. You've also got Delivery Hero in the green this morning, higher more than 6%. This is after Bernstein said that its debt restructure was an overwhelmingly positive step. Analyst William Woods saying that it helps ease any liquidity concerns for Delivery Hero. I did earlier mention Henkel, the maker, of course, of detergents and household products. It had its results this morning about 6:30 a.m. London time, and traders seem to like them. Overall, the margin outlook a little better, even if sales were looking a bit soft. So those shares higher 0.7%. If we just flip over to the losers this morning, Lufthansa, I mentioned earlier, thinking about dropping its plans to buy ITA, the old Alitalia. Shares down at nearly 0.8% this morning on that report from La Repubblica. We also have Santander in the red after it announced job cuts, or we reported potential job cuts on its US retail banking arm, but not too much of a punishment, really. This is a broader trend in the banking space, and it's been hiring in its US investment banking arm. And finally, I did mention that luxury's been suffering. Ferrari down 2.2%. This is after it was cut to sell at Citi, but the big context is it's had a recent share price rally. Back to you.
Okay, Ferrari. That's where Guy's excitement is right now on today, is on the Ferrari story.
Ferrari should be red. Ferrari should be red. Though I have to say, Red Bull over the weekend, smashing it. Verstappen had a very good weekend. So basically, it was a Red Bull and Rashford weekend.
Not the first time we've got to say that. Probably not last time we're going to say that about Max Verstappen. But yeah, wow. Okay, all the controversy aside, the focus on Max Verstappen.
Amazing. And the Rashford goal.
Okay, let's bring in...
So two red things there.
The Rashford goal. Okay, great. Also, by the way, Arsenal women's beating Tottenham women's in the footy as well. Important for your weekend sporting update. Let's cross over and bring in, well, not crossing over anyway. We'll bring in Sophia Horta-Acosta now for a little preview on this UK budget. That's also going to be exciting, whatever Guy has to say. Sophia, what are you going to be looking at? The tax cuts, are they going to come or not? Income tax, national insurance?
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
A bit of a tick up in consumer prices. Again, nothing like the Liz Truss Cozy Carting mini budget. But what would that mean for gilts? What would that mean for the BOE? Guy, you know, it is something that will move UK markets.
There could be an inflation story here. I think it's the read, basically. If that's what people are watching for. There's going to be some small idiosyncratic stories around various little sectors, but the big picture is, if we loosen the purse strings, do we see an inflationary impulse?
And how much pressure is Jeremy Hunt under to kind of deliver those tax cuts? He's seeking to reduce that pressure, perhaps to deliver something that will get markets get voters excited ahead of the election cycle. But how will markets read that? I think that's where we need to focus on. And at the moment, some investors are having kind of a less positive position on gilts, expecting it to be kind of the part of the market that moves the most. But, you know, the pound, gilts, all of that is so dependent on what's happening over in the US as well. Exactly. So I don't think it's just a Jeremy Hunt story.
Sophia, what about the manufacturing side of the equation? How does that read through? We're talking about the inflationary push. Connect the dots for us.
Yeah, so I was looking at this story written by our colleague Joe Mays. £360 million of government and industry investment in manufacturing. Now, this is very small. We were talking about this on the Markets Today blog. How much would Nvidia need to move, and it's to have a £360 million impact on the market? It's about 0.01%. So it's a very small amount, and we don't know how much of that is from the government. But this is again the drip feed of measures that the budget is that the Treasury is announcing before the budget, again to manage expectations and to focus maybe the efforts on which projects the government wants to focus on.
All right, Sophia Horta-Costa from our Markets Today blog. We thank you so much. You can get more from her and the team on the front page of the Bloomberg UK website. All you gotta do is type in TLIV GO on the Bloomberg terminal. There's a lot going on there, guys, in terms of what the read-through might be. She was walking us through some of the market moves. I still haven't been able to connect those dots. If you really will see a big
politics is interesting as well on the inflation question, because if you get, it's the backbenchers on the Tory party pushing for tax cuts. If you get that inflationary impulse, then the Bank of England arguably has to stay higher for longer. Do they want that leading up to an election, the backbenchers? So that there's a tension there.
I wonder if they're thinking that far ahead in terms.
I was about to say, is the reaction function that
they just need to change the poll numbers, don't they?
Is Bailey on the same page as Tom McKenzie? We don't really know. Coming up, the head of the world's biggest infrastructure asset manager joins us. Stick with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Welcome back. This is Markets Today. We are 30 minutes into the European trading session, and this Monday you're seeing modest gains of 0.1% across the European benchmark. Here in the UK, the FTSE 100 is down 0.2%, just shy of 0.2. Over in France, the CAC 40 is off by a little over 0.1%. The DAX just holding on to some very, very modest gains across your sectors. Tech is at the top of the list, up 0.9%. A handoff coming through, of course, from Asia was positive. On the downside, consumer products down 0.8%.
It's exciting.
The excitement is building, Guy.
That's my point. The excitement is definitely building. It starts off at a low, kind of low on Monday. By Friday, with non-farm payrolls, we're gonna be really excited.
I don't know. I feel like the politics gets us excited first, then the monetary policy kind of catches up in the back half.
So I think that, as I was making the point earlier, your point is well made. It's a really interesting kind of handoff this week in terms of the policy story. So in terms of what we've got this week, as Critty says, you've got both the monetary policy story, you've got Powell on the Hill. He's going to be interesting to listen to. I have sat through many of these hearings. You've got to maybe get some popcorn and take some breaks, but listen out for what Elizabeth Warren has to say. So you've got Powell on the Hill. You've got the China story. Tom's very excited about that with the NPC. You've also got the British budget coming up. In terms of this week, with Super Tuesday in the mix as well, which could confirm Trump, and then we start to get a better understanding of his policy framework, I think it's going to be a really interesting week in terms of what dominates. Is it going to be the rate story, or is it going to be potentially that kind of policy volatility story, which looks like it's going to increase? And certainly we'll get our hands around that story as well this week. Let's kind of think, actually, I think we could bring both of these two factors together really well with our next group. Ben Way is Group Head of Macquarie Asset Management and joins us here in London. Ben, great to see you. Look, we've got a really interesting week coming up. We've got a rate story that we're going to be focusing on. We'll talk about that in just a moment. We've also got, I think, a really interesting week in terms of the policy story. China, what's happening with the NPC. You've got Super Tuesday. I think we'll get some idea of what Trump is going to do post that, maybe in a little bit more clarity. The British budget. There's a lot of volatility right now. How are you thinking about, as a long-term investor, how are you navigating this policy volatility, which I think looks like it's going to get worse?
Yeah. Well, first of all, I'm super excited that you're so excited for the week.
Yeah.
And for
not Monday,
yeah.
Rest of the week.
Well, it's good to be excited on a Monday. And certainly, I think you're right. There are two things happening in the world. And I think there are two things that our clients are thinking about a lot, which is how do we navigate a much more complex geopolitical world where every week there seems to be an announcement or a policy decision, which actually make things blurrier rather than clearer. And I think the second thing is about the fact that we're still operating in a much higher rate environment than people are used to. And there's still a real calibration going on around where does relative value across different asset classes sit today, and where is it going, and where should people be deploying their money?
Is that so what is going to determine what happens with that positioning? Is it a rate story? If rates come down or don't come down, is that going to be the biggest determinant in terms of how those assets perform? Or is it going to be what happens with the policy framework, what happens with Trump tariffs, etc.?
Well, I think it's both, to be honest, because I think people are first trying to understand what scenario are they going to be investing into from a geopolitical world. And then the second part will be, depending on that geopolitical scenario, that may well, in fact, affect when rates do come down and how they come down. So I think they're factoring in both those things. And what I think for a lot of long-term investors they're focused on is not so much the cycle, but where are the big structural thematics and how do they play those thematics? And I think, a good example of that obviously is digitalization. We've sort of got the rise and rise of AI and then all the benefits that that's creating within different sectors, for example, things like digital infrastructure and the fact that that's been a boom for data centers and fiber networks and the like. And so people can see that and they're looking, how can they play that thematic because they believe in that thematic, even allowing for the fact that there is more, say, geopolitical uncertainty than there perhaps has been in some decade.
Well, one of those thematic themes is the energy transition, right? And that feels like it's very policy driven by the United States, whether or not we have a Biden 2.0 or potentially a Trump 2.0 in January of 2025, really, I think, feels like it guides a lot of the investment decisions around EV and renewable energies, et cetera. How do you make that call now?
Well, I think that's a really great point. I think there are two things there. One, there's no doubt that the Inflation Reduction Act has been great for energy transition, particularly in America. But it's also created competition around the world, which is meaning other countries and other markets are reacting to that in a positive way. That's the first thing. But I think the second thing is that even allowing for the IRA, investment in the energy transition was at about $1.9 trillion last year. That's double where it was in 2020. So even allowing for the fact that we have had good policy tailwinds around that, there's still a massive move. And that's the real story, because only $600 billion of that was in things like renewable energy. The rest of it's being driven by things like, EVs and electric transport. And so right around the world, we can see that shift occurring really irrespective of policy. But where we get good policy, it really creates more momentum. And I think the US has been the best example of that. And I think when most people look at the US market, for example, around energy transition and EVs, I think irrespective of who's in the White House, there's going to be strong momentum there and it will continue. And that doesn't mean that other more traditional industries are being left behind. We're looking at how we can abate those, how we can evolve those and modernize those. But rational actors all around the world are clearly investing in things like solar and wind because it makes sense from a cost point of view and from an energy diversity point of view.
But when does your return show up as a asset manager? What kind of time horizon are you looking at to actually for that investment to pay off? So
I think for any infrastructure manager, they're looking at it through a medium to long term timetable. So it's not 2 to 3 years; it's over 5, 10 to 15 years. That's generally, certainly in the more private elements of infrastructure, the sort of time frame we bring, and that's why often private capital can work well with communities and governments, because it isn't that short-term capital. It's really about building assets and about helping evolve technologies and scaling them up.
Does that longer-term time horizon allow you to look past the pressures that we're seeing in commercial real estate? Is that something where you're reducing your exposure? If you'd had much exposure, how are you thinking about that as a risk factor?
Yeah, we've had a pretty limited exposure to commercial real estate, so that's not something that we spend a lot of time commenting on. But again, by taking a medium to long-term view on investing, which is what our clients are trusting their money with us to do so, it does allow you to come back to what does deliver, allowing for cycles over 5, 10, 15 years. You come back to the data and then you also look at what thematic do you get excited about because of structural changes in economies or the way people spend or the way they choose to work. And so we therefore allocate capital around those thematics. And
you touched on artificial intelligence in your first answer, or one of your first answers, and you talked about the build-out of data centers. Is the window closing around investing along that theme? Do you want to be targeting other parts, other segments of artificial intelligence, whether it's the apps being built on top of that, the applications, the software, or is there still further to go in terms of the foundations underpinning these models?
If you were to ask me what is one asset class right across the world, it doesn't matter which region you're in. You could be here in Europe and the UK, you could be in the Americas, you can be in Asia, where the asset class being data centers needs more capital, it's that one class. So it is essential, obviously, from a storage capacity point of view to support AI, and I see that going on for years to come. And in fact, if you like, I think it's been a shot of steroids into the data center sector for sure, the rise and rise of AI.
Well, it's still only early doors in terms
exactly
of
right,
building
exactly
out those
right.
data centers.
But the demand we've got for our end users is very extensive.
And it's not just the data centers. You've got to power the data centers. You've got to have the grid.
Exactly
You've got to provide the energy. That seems to be where some of the bottlenecks increasingly appear to be occurring. So it's really interesting, Critty. You've got the AI theme that continues to drive these markets. It is definitely a huge narrative. But I guess the rates theme feels like, at the moment, that's where AI feels like a no-brainer.
Yeah.
AI is going to continue to develop. That's going to be an area where you're going to want to invest wherever it is in terms of the supply chain. The rate story, I find, Torsten Slot's talking about no rate cuts this year.
I mean, this is, I think, where your perspective is really helpful, this kind of longer-term time horizon, because one of the narratives around cutting rates at a time when you're seeing pretty strong American consumer resilience is that we need some sort of normalization of rates, that the last 10-year rate dynamic is not going to be indicative of the next 10 years. Where do you stand on that? What does 5 to 10 years down the road of rates look like?
Yeah, well, I mean, I think the first thing is free money is not normal. So I do think that all investors have to recalibrate around what is an appropriate capital structure, and people probably got a little bit too bullish around the use of debt versus equity. And so I think, again, it comes back to, when you're thinking about investing your clients' money, and, we represent hundreds of millions of people who rely on us for a dignified retirement or to draw on their insurance policies, you can't be playing chicken with that capital. And so you need to have the appropriate capital structures. And I think that comes back to probably why we've had such a standoff between buyers and sellers in the market around M&A, which is people had to really calibrate what is an appropriate return, both as a buyer and a seller, as they were working through the right capital structures where money is no longer free. And so certainly I think those who have had that probably more sensible, longer-term view on the way they were using debt find this a good market and are comfortable with this market, even allowing for the fact that, yes, the cost of debt has gone up and it probably should have gone up.
So as we get comfortable with kind of this new rate environment and the bid offer starts to narrow, are you waiting for that to happen? How far away are we from that happening? Because presumably that's when exits are going to start happening. That's when you start to get maybe this market moving a little bit more. How far away are we from that? And have you got a kind of pipeline of things that you're lining up already for when that process unfolds?
I think what I'd say is it's certainly picking up this year, and I think it will pick up this year. That's not a blinding insight, given that last year was the lowest level of M&A we've seen in a long period of time. But I think when you've got a record level of dry powder on the side in the broader private equity world, including things like infrastructure and agriculture, I think when you've got people better understanding where rates are going to be and retooling their business cases, and I think when you've got actually more liquidity coming onto the market, then it means that you've probably got the right conditions for a lot more activity, and I think that's what we'll see this year.
Where exactly will that activity, where do you think that activity is going to be focused when it comes to the pickup in M&A?
Look, I think it will be about I think there are a lot of sponsors sitting on portfolio companies today that probably makes sense for them to start to think about to exit. So I think you'll see a lot of sponsor sales. I think that would be particularly here in the UK and Europe, and most importantly in the US. I think that's probably where you'll see the biggest deal activity from a geographical point of view. I think, again, whether it be in infrastructure, private equity, or traditional private equity, whether it's core or growth, again, I think there's been a lot of people that have been waiting to look to both to deploy capital and sell, and I think we'll start to see some more willing buyers and sellers.
Air Trunk? Are we going to see, talk me through some of your exits.
Well, I mean, look, generally we don't comment on our exits, but we're certainly opportunistic on behalf of our clients, and we're looking at opportunities all the time. And I think Air Trunk is one good example of where that business has grown unbelievably, and there's great interest in it, and so we'll look at the strategic options for it over the next few months.
Okay, Ben Way, Group Head of Macquarie Asset Management. Thank you very much indeed with a longer-term view on some of these key themes for the markets. We appreciate it. Coming up, we're going to talk to Australian Super's CEO, Paul Schroeder, on why Australia's biggest pension fund is betting big on the UK. That is next. This is Bloomberg.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
There's a serious crisis out there right now.
You're going to have commercial real estate be a little bit of a tricky spot to work through.
I don't think people realize the impact that commercial real estate has on the overall economy.
My base case is it's a grind.
Valuations are down 20%, in some cases for office, 30, 40% or more.
That office story gets worse. There are obviously large exposures, particularly in some of the smaller and regional sized banks, and that's something we're looking out for.
Our regional banking system, as a result of this, is under tremendous stress.
They're the ones that you're going to see have the problems.
Lending by the regionals this year, it's continuing to fall.
The cash flows aren't there to support the amount of debt they have outstanding.
If we get another shock, that's when things start to become more tricky.
Okay, Bloomberg TV guest there on the pressures facing commercial real estate. Let's bring in now the largest pension fund in Australia, the 18th largest in the world, and the largest one in Australia, saying it is on track to increase its investment portfolio here in the UK to more than £18 billion by the end of the decade. The chief executive of Australian Super, Paul Schroeder, is with us now here in the studio. Paul, we want to get your views certainly on real estate, commercial real estate, but let's start with your investment plans in the UK. Good news for UK PLC. Where's that money going?
Yeah, good morning. Look, we're very optimistic about the UK, especially in the long term, so we're backing it in. Got a good crew here, about 105 people on the ground. We're going to expand our exposure by about £10 billion. Digital, mixed-use property, infrastructure in general, energy transition, all great opportunities here in the UK, we think.
Is this a bet on the UK economic prospects? Because the data suggests we're stuck in a stagflationary slump and that may continue for some years ahead, or is it a bet on valuations? Because these assets are looking cheap and you want to add to that.
Oh no, we're long-term investors for members. There's 3.4 million members of the fund, and they want us to create long-term value, and can't get a longer-term value than the UK and London. Banking centre for 1,000 years. It's been a great commerce centre for 2,000 years. We're really able to look over the volatility and think through to create long-term value.
Are you shifting where you're going to invest and what you're going to invest in? You've invested in King's Cross, you've got Canada Water. Are you shifting away from more CRE-type projects into different types of infrastructure projects? Talk me through the mix of this new money.
Yeah, that's a good way to describe it. As I say, we're creating long-term value for members, and we've got to think about, well, where is the future of society going? And it's going to mixed use. It needs digital infrastructure. It needs sheds. It needs trucks. It needs boats. People are buying things from their couches. We want to be able to match that.
But that doesn't sound like offices to me. Are you more cautious on offices?
I think it's reasonable to be cautious on offices post-COVID and a host of other valuations that we've seen. But mixed use, offices in the context of a precinct, a living place. That's what we like about King's Cross. That's what we're excited about in terms of Canada Water. We can deploy capital there over time and have a flexible, modular type of arrangement.
There's a general election coming up, famously,
Yes.
on both sides of the Atlantic. But does that change your view and how you're looking at the future of the UK? What are the risks there?
Well, we've been very fortunate, I think. We've had great relations at the council level, at the UK government level, great interactions with the civil servants. And it's our job, I think, to have good relations with all sides of politics forever, really. So we can't afford, we don't have a dog in the fight. We don't have a view about what the outcome should be. That's a matter for the voters, of course. But it's really important. Members expect us to have great, high, deep quality relations with all governments at all levels.
But if you're talking about having exposure to infrastructure spending, that's obviously going to change based on who's in office.
Oh, but actually, I'd be urging the reverse.
Okay.
For long-term investors, what we need is policy certainty, policy stability. In a way, as long as you've got sensible, logical, commercially orientated politicians who can think about these things, the most important thing is that the policy settings are stable, because we're talking about, billions of pounds over multiple decades for some of these things, and so you need stable policy settings.
We haven't always had that, though, amongst our politicians and amongst our leaders.
No, well,
would be the argument from some. But are you seeing that political stability now?
Oh, I'm really impressed. Actually, I know that it's difficult. It was strange turning up in London and following another Australians, but it's funny to be here and everybody's very critical of their domestic leaders and their domestic economies. But all of the dealings we've had across the spectrum have been very impressive. We just keep urging them to be clear, transparent, and as stable as possible.
Okay. Guy, you want to jump in?
Well, no, clear, transparent, and as stable as possible. Can we talk a little bit about the pressure that is on UK pension funds to do what it's amazing. The Aussies are here, they're investing.
Sure.
There is huge pressure on UK pension funds to now do the same thing. We saw over the weekend plans to increase transparency. We're going to know kind of where this money is going. The argument goes that there's this huge pool of money pension funds should be investing into the UK. That was going to drive some sort of a productivity boom. Should UK pension funds be in a position where government is telling them where that money should be going, do you think?
Oh, I think it'd be the worst nightmare of all if governments told investors how to invest. I think that's just a fraught path. But transparency is a different thing. We've had a thing called portfolio holdings disclosure. So on our website, members of our fund can find out exactly what they own by address, by asset class, by valuation, all of the time. We think that's a tremendously positive development. So transparency, good. Government imposing investment decision, disaster. It's got to be investment thesis. It's got to be investment philosophy. It's got to be risk return. That's not the job for politicians. Policy is the job of politicians. Investing is the job of investors.
Are consolidated funds, are bigger funds better than smaller funds?
Oh, I think, look, you can have poor big funds and you can have good small funds, but overwhelmingly, consolidated, stronger, bigger funds are able to attract more talent, have more mature systems. So the idea of fewer pots and fewer funds will lead to a greater, stronger system.
Talk to us about your approach when it comes to illiquid assets. It's something that you do very well. It's something that the UK government wants to be doing very well, but there's a real hesitation to get near it because of how risky it can be. How do you navigate that?
I think it's very important. I think the broad idea is an important one. The idea that pension funds invest in illiquid assets. There's a very good match, actually, between the asset and liability of an illiquid asset. You need to manage liquidity a great deal more and much more sharply. We've got some advantages in the sense that we're growing with net cash flow. It's harder when you're shrinking and net outflows, but I think that the government's right to be encouraging funds to be thinking more and more about this, as long as they manage their liquidity well and think about creating long-term value.
So if you're talking then about the fact that you're growing, you have all these inflows, is any of that being deployed to private credit? Is that something on your radar?
Yep. Yeah, no, we have a private credit team here in London and a very well-established team in Australia. You know, the thing about private credit from mine is just watching for defaults, and as economies slow down, that can be a heightened risk.
What's your time frame on that?
To be more precise about your question, if you want.
Yeah, your time frame. When are you expecting kind of a wave of those defaults, a wave of those cracks? At a time when so many people have that exposure to private credit, we're waiting for that liquidity.
Yeah, I understand. I think once you're seeing double-digit returns, then you see money pour in, then people get pushed up the risk curve, and then it starts to get dangerous. So I think we're just cautious.
So that caution's there. You have that long-term horizon. Rates, obviously, we know, elevated. We're waiting for when we get more clarity on when they come down. But is there a black swan event? I mean, kind of following on Critty's point, how are you thinking about the potential black swan in this higher rate environment? Even if you have that longer-term view, how are you looking to mitigate that?
Yeah, so we spent last year thinking that something bad was about to happen. We spent most of last year de-risked a little and thinking that you've got a historic rise in rates across the globe.
Yeah.
And usually something breaks, right? Usually when central banks very aggressively embark on a path, something breaks. But if you look at the market now, they're sort of pricing in a softer landing and that the rates will return. But that's a little unsettling, I think, when everybody seems to be quite, relaxed about that. From our point of view, we probably got last year wrong. We thought something bad was going to happen more quickly. We're thinking maybe that's less likely to happen now, but we look at this year more about sort of muddling along than that disaster occurring. But we've just got to be very thoughtful about the outlook, keep being vigilant about that, and valuations. Yep. Buy things at the wrong price, get yourself in a lot of trouble.
Paul, I'm sitting here, I'm mesmerised by what you're saying, but I'm also mesmerised by the tie.
Ah, fantastic.
Talk me through the tie.
Serious tie envy.
I'd love to. Well, I wore this deliberately because it's an Aboriginal and Torres Strait Islander print.
Yeah.
And I thought, here I am in London, I better pay respects to our traditional custodians over 65,000 years.
Yeah.
But it was sewn by a colleague, so I'm delighted to. And it's Australian Super Orange as well.
The Aussies are here today.
How do we follow that?
You can't follow that tie, believe you me.
Stay tuned for what Tom and Guy wear tomorrow.
Thanks.
Setting the standards high.
I'm never going to be able to match that. Maybe his tie's off. Maybe that's the that's the only way to.
No, veto.
Are we taking a close up yet of the tie? We need to take a close up.
I'm delighted to help you there.
Yeah.
There's the tie.
There's the tie.
Thanks very much.
It's fantastic. Great to see you. I can't believe we've had two Aussies. Basically, there's an Aussie back end to this show, which is fantastic.
We're coming out on Waltz and Matilda, aren't we? We're going to have a bit of sound up.
Well, as long as we don't talk about sport, everything else is fine.
Well, we're in the same camp, I think, when it comes to England.
The sport, yeah, precisely. We'll talk about Aussie rugby. We'll talk about English rugby. There's some good football over the weekend. Anyway, great to see you. Thanks for stopping. Come back again. It'd be fantastic to see you. I know you're going to be spending much more time in town now that you've got such a big team being built here. Paul, nice to see you. Paul Schroeder, the Chief Executive of the Australian Super Pension Fund. OK, what are we going to be talking about next? You've kind of got the idea. It's a quiet start to this week. But up next, we're going to be talking more about what the week ahead holds us. We've got some incredible events coming up later this week. I can't work out if it's a policy week or a rates week. We'll talk about that next. Coming up, plenty more conversations. We've got them in the next hour as well. Citigroup Chief Client Officer David Livingston is going to be joining shortly. Plus, we're going to speak to the CEO. I'm never quite sure how to say this. Zoetis? Anyway, it's the largest producer of pet medication. And we're going to be talking about Illy Coffee. That is definitely one of my favourite subjects. Francine's got a great show lined up. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Next time on The Deal.
I realized a long time ago that being a football player or an athlete, you can get into a room, but once you get in the room, you have to prove that you belong there. But what keeps you in the room, right? It's your talent. It's the talent that a lot of people don't see or don't think you have because they've only seen you in one way. And for me, the biggest pivot was getting out of my own way, telling myself that I'm more than just a football player.
Could face bigger challenges. Britain's next.
Was going to keep winning World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The record run continues for global markets. Japan's Nikkei 225 tops 40,000 for the first time after another all-time high on Wall Street. Testimony from Fed Chair Jay Powell is in focus for investors this week. China set to unveil targets and strategies for reviving the economy at the nation's top political annual gathering. Beijing scraps the premier's press briefing, breaking 3 decades of convention. Plus, the U.S. says Israel has essentially agreed to a 6-week ceasefire if Hamas releases vulnerable hostages, while American and Jordanian planes start dropping aid into Gaza. Now, also coming up this hour, we'll bring you top guests across a range of sectors. We're speaking to Citigroup Chief Client Officer David Livingstone. He joins us shortly. Plus, we'll also speak to the Chief Executive of Zoetis, the world's largest producer of pet medication, and also the chairman of the Italian coffee company Illy Caffè. But first thing is first, so let's look at European markets, and they may give us an indication of what's coming up ahead. Now, we do have a very busy week in terms of central banks. Also, data coming out of the U.S. and new forecast from the European or the Eurozone that could give Madame Lagarde an impetus to say that the next move is down, but also wait for wage growth to see exactly the timing of that. Now, global markets overall, we're on a tear. So for the moment, you can see European markets actually are pausing after this record high after 6 weeks of gains. Global markets set for fresh records. Again, we were saying the Nikkei 225 closing above 40,000. For the first time. Now, it comes at the start of a big week, which includes China's NPC, the Fed chair's testimony, the ECB actually forecast, and a UK budget. Now, joining us is our very own Justina Lee, our markets reporter. Justina, there's quite a lot going on this week. I think it all has to do with these record high equities. I don't know what will support them going forward, but I know on Friday, Bank of America was just the latest one to say, look, they can go 5% higher from that record close on Friday. Like, what will support markets?
Yeah, it really is pretty incredible. I mean, in the U.S., I think in Japan, there are sort of like 2 different versions of the Goldilocks narrative. And I think last week, kind of very notably in the U.S., the core PCE number was like, you know, I think it was something that the investors were comfortable with, that maybe the Fed doesn't need to be a lot more hawkish. And I mean, it was notable that, you know, the S&P keeps going up. Bitcoin kind of kept going up as well. Carvana was up, Beyond Meat was up. So it does feel like, you know, there's like kind of, it's like at the peak of the party right there, like around midnight. And in Japan, I mean, we're kind of seeing the same, where we first saw the foreign investors rush in, you know, because the yen was weak and maybe inflation is picking up, corporate profits were picking up, but at the same time, the BOJ was going slow. And I think it's notable that now we're seeing more local investors come in as well. I mean, there was a securities kind of brokerage app that actually crashed, and I think that's always, you know, a telltale sign.
But Justina, when you look at some of the supports, is it just because money needs to go somewhere and because bonds are a little bit tricky at the moment? Or is there underlying strength, for example, in some of the earnings stories that we've seen, but also fundamentals in the economy getting better?
Yeah, I think in Japan and the US, you definitely see kind of corporate profits also supporting that bullish stance, right? Especially in the US, where kind of even after a few strong years, you still saw pretty strong corporate earnings growth. Now, a lot of that was concentrated in the tech space, and I think that kind of explains why, I mean, NVIDIA is still going up. But at the end of the day, on an index level, the US index is very tech-driven. And you can talk about concentration all you want, but kind of for anyone who's just investing in the benchmark, I mean, that's been good news so far.
Where are you finding the most interesting stories? I know this week is going to be very weak, a big week because we have the Jay Powell testimony, but also we have new forecasts from the ECB, so it could guide the ECB to say, look, we're going to get a cut. Let's look for wage growth to see what happens, when the timing of that is.
Yeah, it's kind of interesting because with the U.S. economy, I mean, there have been some signs that it might even be re-accelerating. So actually last week we had kind of Apollo's economist saying that maybe the Fed, there will be no rate cuts this year at all. And I think that will be a surprise to markets. I mean, this week we're getting kind of Powell's testimony to Congress, as well as kind of the jobs growth number on Friday. And I think that will be kind of a clear indication of whether there is that much evidence behind the re-acceleration thesis.
And Justina, then a lot of focus, of course, on fiscal policy with the budget here on Wednesday.
Yeah, I think so. And kind of both kind of here as well as in China, I think here where people are also looking to see whether there are kind of like more policies to support the listings in the UK market and the financial market in particular, after all the concerns about a lot of companies kind of not listing in the UK and the market just generally shrinking.
Is there anything else that you're looking forward to? I mean, we've avoided a shutdown in the US, so that's a good thing. Does it go back to auctions, for example, of Treasury as the main focus?
Yeah, I think that's one. And another big one will be kind of the targets coming out of China. I mean, economists are expecting the targets to stay roughly the same, 5% GDP target, but also not necessarily like a bazooka-style stimulus, as JP Morgan economists said. But I think people will be looking for comments around how China plans to kind of support consumption, for instance, and achieve what they call like high-quality growth instead of kind of the old export-driven model.
So, Justina, we have a lot of the big speeches tomorrow. What are you looking out for? Is it the property sector? Is it just more, in general, more policies to support that growth in China?
Yeah, because I think when we look at the stock market so far, I mean, a lot of the support measures have been kind of like cosmetic. They're more about sort of like stopping people from selling stocks. So I think people really are looking for more kind of like structural support. So that will be around the property market. It will be around how they're going to encourage people to kind of buy more appliances. It will also be around, how they plan to support particular like key industries such as electric vehicles and batteries and renewable energy, kind of amid this like deteriorating relations with the U.S.
Justina, thank you so much. Our Bloomberg Markets reporter there, Justina Lee. Now, we're also looking at pre-market Arc House Management and Brigade Capital Management having boosted their offer for Macy's by 14% after the retail rebuffed a previous proposal. Macy's in January rejected the bid from the investor group, saying the offer lacked compelling value. The company has instead unveiled a restructuring that includes plans to close almost a third of its U.S. locations while growing its Bloomingdale's and Bluemercury brands. Coming up, the U.S. Vice President Kamala Harris joins calls for a temporary ceasefire in Gaza. We'll look at the latest on negotiations next, and this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Now, the U.S. says Israel has effectively agreed to a 6-week ceasefire in exchange for vulnerable hostages being held in Gaza. Now, Hamas officials are now heading to Cairo to outline their positions. Now, Rosalind Matheson, Bloomberg's EMEA news director, joins us now. Rosalind, these things could actually turn quite quickly, so it's unclear at the moment whether the optimism that the U.S. has really put on a ceasefire will come to fruition.
Well, that's right. We know that Israel has agreed, the U.S. says, to the broad terms of a ceasefire, but that still has to be presented to Hamas. Hamas has to agree. And what we're hearing, of course, is that Hamas officials are still going to Cairo for conversations. Will Israel turn up for those conversations? They refused to do so before they want to negotiate through intermediaries like Qatar and Egypt. We also know that there are a lot of outstanding issues before they even agree to the terms of a ceasefire. So these are the terms to agree to the terms of a ceasefire, and that includes things around the conditions of the hostages, their whereabouts, their names, which of the hostages are still alive. These are the Israeli hostages being held inside Gaza, and their condition, how healthy are they? And Israel wants all of that before they agree to actually sit down to discuss a proper ceasefire. Hamas is saying other things. They want understandings about whether they can move their troops back into north of Gaza, for example. So it's possible all of this could still fall apart.
Ros, how much pressure is there actually from the U.S.? I mean, we heard the vice president's tone change in, calling for a ceasefire, and also the U.S. saying that they're going to send, air aids.
Well, that's right. What you're seeing, the tone from the US is increasingly one of exasperation, frustration, both publicly and behind the scenes. With Israel, that's, of course, over the humanitarian situation inside Gaza, and making the political point as well of saying we know that Jordan and other nations have been doing airdrops of aid in recent weeks. The US is now doing them directly, and that's expressing direct concern about what's happening inside Gaza. You can see the tone from Kamala Harris, from Joe Biden in recent weeks. The reality, though, is Israel says that they feel that they have to do this course. They feel they need to do what they say is necessary to eradicate Hamas. They've given a deadline for the exchange of for their hostages to come back to avoid an offensive in Rafah in the south of Gaza. That's what everybody is very concerned about. So regardless of the pressure from the US, the UK, Europe, whoever, Israel says they have to push forward with this.
Ros, there's also an Israeli cabinet member who's going actually to the White House. How significant is that?
Well, it's interesting to see Benny Gantz, who's a member of the War Cabinet, going to the US potentially for these conversations. He's much more of a centrist than Benjamin Netanyahu. They've clashed often politically at home. They've been political opponents over the years. They are in the War Cabinet together, and obviously under the terms of the War Cabinet, they all have to agree, for example, to start an offensive in Rafah. So the US is probably hoping they can peel Benny Gantz off a bit and get him to pause or to urge, for a stay in that offensive. Whether that's going to be successful remains to be seen. But again, it does show that the US is trying everything it can here to try and stave Israel off.
Ros, thank you so much. As always, Ros Matheson there, who heads our EMEA news desk. Now, coming up, the UK Chancellor Jeremy Hunt considers his tax-cutting options in Wednesday's budget. We'll be discussing all of that and much more with David Livingstone, the Chief Client Officer at Citigroup. That's next, and this is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. On March 6th, Chancellor of the Exchequer Jeremy Hunt delivers the UK's next budget, with his Conservative Party lagging in the polls ahead of the next general election. Bloomberg Television brings you up-to-the-minute special coverage, Wednesday on Bloomberg.
Well, my next guest is Chief Client Officer at Citigroup, a new position which the bank created late last year. Under his previous role as Chief Executive in EMEA, he helped the bank to navigate the pandemic and also led the firm's response to the Russian invasion of Ukraine and sanctions against Moscow. Now, he's a member of the company's executive management team as the Wall Street giant oversees its biggest restructuring in 2 decades. Well, David Livingstone joins us to discuss the UK budget and much more. David, thank you so much for joining us. I know you've been extremely busy over the last couple of years, frankly, with the restructuring, but also with the I guess, the difficulties that a lot of financial banks have found themselves in. Are you seeing green shoots for deals and anything in the pipeline?
Well, if you're talking about that through capital markets and M&A activity, yes, we are. If you look at the beginning of this year, it's been a very, very busy period, particularly in debt capital markets, as treasurers have taken the opportunity of a bit more clarity on interest rates to fund and take advantage of liquidity. And M&A, I think, is, after 10 quarters or so of muted activity after the boom of 2021, I think there are green shoots because there's more confidence as corporate leaders look forward and say, we can see a path of where inflation and where interest rates will go and perhaps where growth will be.
Are you surprised that actually we haven't seen any more casualties because of the higher interest rates?
Well, need to remember that interest rates are higher but not high, and therefore, in historical terms. And therefore, the ability to manage it really rather depends on how extremely leveraged you were going into this period of raising interest rates. And there's a period of being able to manage through that, particularly taking advantage of people have a lot of hedging in place and other things. So no, we haven't been sort of surprised, but we've been, I suppose, positively attuned to the resilience in the markets.
David, when you speak to clients and you travel around the world to speak to Citi clients, because of the big restructuring that your chief executive and yourself have put in place, what's the question you get asked the most?
I'll change one word. It's a reorganization, not a restructuring. Okay. And that's important because really what Jane Fraser has led is what we announced in September is having our structure catch up with our strategy. Our strategy remains the same. We are the world's most international banking organization, and that remains absolutely the case. But our structure didn't fit the profile of what we wanted to be now, so we've simplified, taken out layers, and put a much greater emphasis, and hence my new role, on delivery to clients.
I know last week was, you were the talk of the town with the fact that you actually have Viz joining from JP Morgan.
Yep.
How will that change things at the bank?
We're very excited about Viz joining. I mean, he's an excellent banker. I'm sure you know him. He's very well respected by clients and for his market insight and judgment. Our banking business is a very significant business for us, and Viz will be in charge of our investment banking, corporate banking, commercial banking activities. And I think it is a statement of our ambition in all of those areas to have someone of Viz's quality and stature. He's attracted by the globality of Citi. He's attracted by the story of what we can do and how we can do more for clients.
Do you know where he'll be based yet? And does that give a signal on where also Citi wants to focus on?
Hopefully on an aeroplane, I think will be Viz's mandate. He will, very international by not only his background, but also the business need.
I know you've also bet on Canary Wharf, right, as something that will do quite well in the coming years. Is that an attractive place to be?
I think so. I mean, I think the Canary Wharf Group and Shobi Khan are doing an excellent job on post-pandemic recovery in Canary Wharf. It's not what it used to be, but that's actually a good thing because the retail and services and entertainment side are very strong, and you're seeing a very significant increase in the life sciences and other tenants using the Canary Wharf estate. And for us, it's been our home for 25 years, and it will continue to be so.
David, are your clients banking differently to what they were like, 5-6 years ago because of AI, because of some of the technology, but also, I guess, because of the differentiation in some of the Wall Street banks?
They are banking differently because their business models are changing. So if you look at the effect of digitization, even before you get to blockchain or AI, you're seeing businesses being able to go global much more quickly. So they can move through their own sort of use of e-commerce into very, very global markets very quickly. So they need a different type of banking services earlier in their development, not only the payments, working capital management, but insight into how to operate in markets before they build their own capability to do so.
So what does that mean? Being closer to your client in different jurisdictions? Does it mean actually hiring in maybe some of the places which is trickier for the clients to know exactly what's going on?
But both of those, but that's the footprint that we already have. So if you look at the opportunities, Middle East is a very good example, Africa, Latin America, they're places where clients are extending not only their own businesses, but also their supply chains. And that's something that we're set up to serve.
We have a big UK budget on Wednesday, probably the most important one for the Tories if they're not going to lose this election. What are you expecting in the budget?
Well, a lot of it has already been, I think, sort of pre-trawled, because I think the Chancellor doesn't have very significant degrees of freedom. If you look at the UK budget is £1.2 trillion, and the estimates are that he has 20 billion pounds of freedom over the 5-year forecast period. So that's not a great deal of flexibility. So we anticipate there'll be some modest increase in tax take, but also most of that being given back through some relief for around national insurance and also maybe some of the lower tax rate relief. But that's not very significant when you're actually managing a £1.2 trillion budget, and really it's on the spending side where most of our clients would say, well, that's where the reform is needed, and that's where more clarity is required by this government or future governments.
Yeah, I was going to ask about the future government. I mean, if you look at the polls, it's very likely that Labour get in. Have you spoken to Labour? Have they come to speak to you? What do your clients worry most about a Labour government?
Our clients are always focused on policy and policy settings. And if you think about the UK, the issues are around competitiveness. Yeah. They're around corporate tax rate. They're about labour productivity. And planning and infrastructure. I mean, they're the issues that our clients in the UK are most focused about, and that's what they engage with government, and I suppose we do too, on those dimensions. I mean, financial services reform has been very, very solid under the current Chancellor, but most of the Mansion House and other initiatives are longer term in their impact. But most of our clients are focused on what's the continued reform agenda in the UK.
What about non-DOMs?
Not that relevant.
It's not something that people are talking about, or it doesn't really make a difference to your client base?
No.
All right. Are you bullish overall about the UK? I mean, there's so much dividing politics elsewhere in the world. I've heard that the UK looks relatively stable compared to other countries, and so does it make it attractive?
Well, you could say from a policy point of view, there isn't a necessarily huge gap between the major parties. Look, the UK retains all of its attractive features, time zone, language, law, all of those things, but it can't rely on those forever. And therefore, it needs to keep up this pace of structural reform in the economy to get growth back. And I think the distinctive thing in the UK to worry about is labour productivity. I think we're seeing other places in the world recovering faster post-pandemic than the UK has, and that's something that needs to be kept an eye on.
David, you mentioned a couple of times, the fact that Citigroup has a big global footprint.
Yes.
Geographically, where are you most excited about?
The United States, actually. I think the US remains that flexible economy. We've seen the level of recovery. You see it's being translated into stock market, valuations. And I think
productivity.
And productivity.
Incredible.
Yeah. We'll see the jobs report later this week. But I think it is. I think that's a market where we still see very significant upside for generally and also for us at Citi.
And this is what animal spirits coming back, also for deals specifically in the US.
It's not just deals. It's that underlying economic activity and vibrancy, which does need financing. It needs the support that the banking system can give it. Yes.
David, thank you so much for joining us today. You'll have to come back really soon. It was a great conversation with David Livingstone there, the Chief Client Officer at Citigroup. Now, coming up, we'll look at the animal healthcare industry with the Chief Executive of Zoetis. It's a listed company. We discuss vaccines, artificial intelligence, but also consumer spending. That conversation is up next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
Now, Now, the record run continues for global markets. Japan's Nikkei 225 tops 40,000 for the first time after another all-time high on Wall Street, while testimony from Fed Chair Jay Powell is in focus for investors this week. The U.S. says Israel has essentially agreed to a 6-week ceasefire if Hamas releases vulnerable hostages. American and Jordanian planes start dropping aid into Gaza. Plus, China is set to unveil targets and strategies for reviving the economy at the nation's top political annual gathering. But Beijing scraps the premier's press briefing, breaking 3 decades of convention. Well, good morning, everyone. Welcome to The Pulse. Happy Monday. I'm Francine Lacqua here in London. So Zoetis was a top buy amongst insurance companies last quarter, with shares in the animal health provider gaining 13%. The Fortune 500 company focuses on livestock and household pets by discovering and manufacturing vaccines and medicines. Now, the global pet market has surged since the pandemic, and according to Bloomberg Intelligence, it's projected to be worth almost $500 billion by 2030, up more than 50% from today. Well, I'm very pleased to be joined by the Chief Executive of Zoetis, Kristen Peck. Kristen, thank you so much for joining us. Welcome to London. I know you're here for a couple of days. I mean, when we saw what Zoetis did, so many in the newsroom said actually, if they had to start a business, this would probably be the thing that they would go into, because our relationship with our pets have grown so much. Have you seen the spend of household per pet also go up?
Yeah, I mean, it's a phenomenal industry with incredible macro economics, behind it. If you look at the industry, historically, it's grown around 5%. And Zoetis, as the industry leader through innovation, has actually grown about 3% faster than the industry over the last 11 years since we IPO'd. And with that growth, we've delivered 625% total shareholder return. So it's been really driven by innovation across our companion animal and our livestock portfolios.
Chris, so what does that mean in terms of how much you grow? This is innovation in vaccines and pet care. Is it also new business models? Are you launching into new groups? Because again, we're talking off air, most people love their pets so much, unless there's a concern with household income, you give them the best.
Yeah, so if you look at it, over 90% of pet owners would, quote, pay whatever it takes to take care of their pet. And really what Zoetis has brought to that is a bunch of new products and new solutions. We're the leader in monoclonal antibodies for pets, so you see those in humans. And a lot of the same technologies you see in human healthcare, we've brought to pet care. So we have 2 osteoarthritis products, Librela for dogs and Silencia for cats, that you can get at your local vet. We make dermatology monoclonal antibodies, Cytopoint. We also do AI-generated diagnostics, such as our Images platform. So there's a lot of new products and new business models we're bringing to the animal health space across both companion animal and livestock.
I know there's always the cost of how much, of course, veterinaries, take. There are, of course, insurance models and things like that. But is that changing? There are more models now of trying to go for cheaper pet care, but then I guess more expensive solutions if the animal's actually sick.
Yeah, I think, pet owners really want to treat their pets the way they treat their family. And their openness to new solutions is quite different. You're seeing a lot now of insurance products, expanding, certainly in Europe, where you've seen insurance products really take over, because they want to make sure if there is a crisis and they need to get the best care for their pets, if there's, they want to make sure they have that available to them. But you are seeing pet owners engage.
See? Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo. We can do that. Bingo's my cockapoo. Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo.
Images platform there, we can look at urine, blood smear, and fecal, and in the same visit, give you a diagnosis. You don't even have that normally with humans, so we can even diagnose oncology and cancer at a vet visit and get your vet on the line with an expert pathologist to not just tell you exactly what it is, but potential treatment paths forward. So really, the quality of care that we can bring to the vet clinic is why pet owners are willing to pay. They feel their pet is truly getting the best pet care, and sometimes better than what they can even see for themselves.
But Christine, I guess, with the cost of living crisis, inflation at 8-9%, are you having to keep costs down? So is there, I guess it's a give and take, right? Innovation.
Yeah, I mean, we've pulled people in globally in over 7 markets and said, if we reduced your total income by 20%, how would that affect what you'd spend on your pet care? And pet owners wouldn't spend any less. We sometimes see when things are challenging, they'll reduce wellness care. Like maybe I can delay that appointment. Maybe I don't have to give all my parasiticides. But if their pet is sick, The fact of the matter is they're willing to spend whatever it takes.
So is there a mature market? I don't know whether you have, a geographical country that you see as the El Dorado for like a template for other ones.
You would think it's a mature country, but if you look at the UK in 2020.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
15% last year, Brazil. So we're a very global company, and we see the growth of population. Adding 10 billion more people by 2050 means a lot more pets and a lot more people eating a lot more protein. So the macroeconomics that drive animal health are very strong.
Where are the biggest margins, actually? Is it, when you look at, I guess, the pet care in general, and that could be nutrition?
And generally, the pet care margins are higher than our livestock. We primarily make medicines, vaccines, monoclonal antibodies, diagnostics, so we're not in the sort of food nutrition side of the business. Generally speaking, pet care is a higher margin than our livestock business.
But could you go into nutrition, or is it just not an attractive market at the moment?
Our focus is really more in things that have intellectual property. We have, we spent over, $4 billion since we IPO'd on our R&D. And I think we really look at things where we can, create intellectual property and really differentiate and drive innovation. So in spaces where you see that, and obviously healthy margins, as you know, for us, those are spaces we focus on.
Any acquisitions?
We've completed a bunch of small ones, actually, in monoclonal antibodies. PetMedix was one, Adivo was one. So our real focus, as I said, is really on these emerging technologies that are going to drive innovation into the future.
Kristen, thank you so much for joining us today. What a great conversation. Kristen Peck there, the Chief Executive of Zoetis. Now, coming up, we'll take a look at how changing consumer habits and climate concerns are also weighing on the coffee industry. So we go from the pet industry to the coffee industry. That's a perfect Monday Pulse. That's next. We speak to the ILI chairman, and this is Bloomberg.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
On an industry which is also grappling with the effects of climate change. Also on the radar, far-reaching new European Union rules aimed at preventing deforestation. So let's discuss all of this with Andrea Illy, the chairman of Illy Café. Andrea, thank you so much, as always, for joining us. I mean, know you're brilliant. I mean, most of our people in the newsroom, but also are watching at home, are obsessed with coffee, and I'm putting myself into this category. So we'll have a good conversation on trends in coffee drinking, but also deforestation. You, from a very long time, have worked on agricultural ways to be fairer. What do you make of this new deforestation law from the EU?
Well, the deforestation law, so first of all, good morning, Francine. Pleased to be here. The deforestation law is impactful in a sense that it puts regulations instead of incentives, which are difficult to match from producing countries because they are not equipped technologically to provide the geographical coordinates and full traceability that the European Union requires in such a short time. But I think with a lot of work and private investment and support, we will be able to, at least for the majority of countries, to make it. Yeah. And this is positive in a sense that it will kind of certify that coffee is not grown in deforested areas. Yeah. Although, my very personal opinion, it is already not grown in deforested areas. So I'm a little bit perplexed with the evaluation of the European Union, which considers 7% of the coffee grown in deforested areas, whereas in my, let's say, figures that are more or less around 0%.
But so where do you see the mismatch? Are they counting deforested areas differently?
Yeah, it's difficult to count because many regions where coffee is grown in Africa are not traced. So how can you really make an assessment with satellites? But satellites are not fully reliable, let's say, technologies. You need to combine satellites with a local, let's say, foot on ground, let's say, check, which is being done now. So it's very complex. But eventually, I think it will happen.
So you don't think there should be a delay, actually, in this law?
Of course, there is a request for delaying because they have a strong impact. But I think the European Commission is pushing back. Yeah. So we will be able to make it. The easiest way is to make a good compromise about the level of, let's say, of the detail of the traceability, which is required. So this is something on which the European Union did not provide the details. And this is where there is the negotiation, let's say, space to find a decent compromise.
Andrea, and you've been thinking about this for quite some time to try and make actually agricultural ways more sustainable, right, more environmentally friendly. Are you worried that we're in a period where we care less about green technology and doing good for the environment because of the number of crises we face?
So, yes, coffee is dramatically impacted by climate change. Up to 50% of the currently suitable land will not be suitable any longer as a consequence of climate events by 2050. But two good news. First of all, regenerative agriculture proves to be successful, not only in becoming more resilient to climate change. You literally nourish the soil with organic carbon, So the soil biodiversity produces fertility, water retention, and also defenses against pathogens. Great. So you get rid of most of the fertilizers, most of the pesticides, everything. And on top of this, you maintain productivity, but with lower cost. Yeah. And quality is amazingly higher.
But it's more expensive.
No,
to start with, it's not more expensive?
No, more expensive.
So why have people delayed putting that in place?
No, they don't delay. They are skyrocketing. So we launched this regenerative framework in 2018, and with our great satisfaction, already 80% of the growers working with Illy adopted regenerative practices. And cherry on the cake, the last Ernesto Illy International Coffee Award has been won by a Brazilian coffee lot, regenerative.
So, but this is for Illy. I mean, you have a whole, there's a whole.
This is not only for Illy, because other companies are doing the same, following the same path. So it's becoming a trend. And the other positive aspects, completing the answer to your question, is that there is now an awareness that we need development funds. We need to create a coffee resilience fund in order to invest $10 billion in the next 10 years in order to, let's say, adapt the coffee plantations in terms of improving agronomical practices, possibly regenerative or similar, and also renovating the plantations with more younger and more resilient plants.
And Andrea, overall, I mean, there's always, reports saying, they have concerns about child labor in the coffee industry in general, not necessarily Illy. But are you happy with the way practices are going? Are they fairer, and are they better than they were 10 years ago?
Things are continuously improving. I must say that all these fair trade and certification schemes like USCAPE and others, Rainforest Alliance, did create a lot of, let's say, benefit in terms of this kind of social issues. But also this legislation that is coming from the UE is, let's say, enforcing aspects like child labor and social conditions. So this is going in the right direction.
Andrea, how are coffee tastes changing? So we had this report saying that Asian countries are going to drink much more coffee again than they did 5-10 years ago. Are our tastes changing in the kind of coffee we want to drink and taste?
This is a trend, the decommoditization of coffee towards much more premium taste and gourmet coffee, prepared usually espresso. So the origin of the taste, let's say, is the Italian espresso, then could be with latte, cappuccino, or others. This is a trend which started 20 years ago, also in Asia, and which is continuing. So more and more micro roasters, more and more coffee shop chains, more and more micro lots and farms producing premium coffee. This is now, let's say, a robust trend of growth, and the gourmet coffee segment conquers more and more space on the top of the pyramid, which is, I would calculate now at least 12% of the coffee being gourmet.
So I think last time you were on, you said, Illy could be looking at a possible IPO in 2026. Is that still on the cards? Is it something that could
Absolutely. So this is a necessity because we have a private equity fund, our very good investor, Ron Capital. They will have an exit, and by default, the exit would be the IPO. But this, in our case, is consistent with the model of a kind of a world-class organization, like I like to describe. A family-controlled business, but a business, let's say, a management-led business, which is the best combination of both. And for that, let's say, challenge, the company is continuing progressing organization-wise, performance-wise, improving our, financial ratios. We're just launching an extraordinary investment plan for doubling our production capacity, but also developing new products, much more innovative and also consistent with this regenerative model. So everything is in progress and positive.
Andrea, I have like 35 questions from viewers asking me, is it okay to have a cappuccino after midday? This is the only question that really is worth answering.
Typically would replacing a dessert after lunch. Typically,
cappuccino.
Cappuccino. Many people do it, particularly in the States. Maybe people feeling that there are less calories. You get the combination of dessert and coffee at the same time.
So there you go. This is big news. Andrea Illy, thank you so much, as always, for joining us. That was the chairman of Illy Café. Coming up, for the first time in 3 decades, the Chinese premier is skipping a press briefing at the annual NPC political meetings in Beijing. We discuss what it means for investors and what it means for policy next. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So China's most important political gatherings begin in Beijing a little bit later today. Now, leaders are set to unveil their targets and strategies to revive the economy. But the Premier, Li Qiang, will not be holding a briefing at the close of the annual National People's Congress. Well, Bloomberg's Rebecca Chung joins us now live. So, Rebecca, surprise move by the Premier. How unusual is this?
Well, it's certainly a big decision. As you say, we have been having these annual briefings by the Premier every single year since 1993. And one reason why it's such a shock is that for people in China, it's really the only opportunity they get each year to see China's number two in a more sort of unscripted, candid and human light. And it's worth saying that's in part because of how previous premiers have used this as an opportunity. So Li Keqiang, who's the predecessor for the current Premier Li Qiang, he used to joke with reporters. He used to joke about his own strong Anhui provincial comment and accent. And he also once triggered this nationwide debate about poverty. So it really was this chance to speak directly to people. And I think cancelling the briefing is an important signal about how Xi Jinping intends to proceed with his third term, eliminating this opportunity, this one channel to speak directly about policy making decisions, as well as also quite significantly diminishing the importance of that role of the premier within China itself too.
So what will investors be watching for, Rebecca?
Well, the one really big item is going to be the GDP target. That is the big thing that investors watch every year. Consensus is that we will see it somewhere around 5%, but the thing that investors will be looking for is the type of language around that 5% target. Just how hard, just how convincing are they? Are they policymakers going to say, we absolutely will make this at all costs, or might they be a little bit looser around their language? And of course, anything that comes below 5% is going to be a disappointment for the market.
So what are the expectations for fiscal stimulus?
Well, provided that we have that 5% target, that is going to be tougher to reach than it was last year, because last year we were coming off that low base. China was rebounding and we were reopening. And so the expectation is that to get to that kind of level this year, we would have to see fiscal stimulus enforced more swiftly and also enforced more forcefully. Particularly, we would also be watching quite closely for any other kind of support for the property market, which continues to be, of course, a real drag on the Chinese economy.
Rebecca, thank you so much. As always, Bloomberg's Rebecca Wilkins. Now, we're also looking at Macy's jumping pre-market after Ark House Management and Brigade Capital Management boosted their offer for the company by 14%. That's after the retailer rebuffed a previous proposal. Now, Macy's in January rejected the bid from the investor group, saying the offer lacked compelling value. Up next, Bloomberg Brief with Danny Berger and Manish Krani in New York. We'll have a full roundup, of course, of markets. We had a big day on Friday where we saw record highs, and then Bank of America saying they expect a lot of the U.S. indices to still go higher. So a full roundup of Big Data Week and markets. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Next time on The Deal.
I realized a long time ago that being a football player or an athlete, you can get into a room, but once you get in the room, you have to prove that you belong there. But what keeps you in the room, right? It's your talent. It's the talent that a lot of people don't see or don't think you have because they've only seen you in one way. And for me, the biggest pivot was getting out of my own way, telling myself that I'm more than just a football player.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Risk-on momentum continues. Markets count down to Powell's testimony, State of the Union, and that pivotal jobs report.
Meanwhile, oil trades near this year's highs as OPEC Plus agrees to extend supply cuts.
And Vice President Kamala Harris calls for a temporary ceasefire between Israel and Hamas, and the talks drag on. A very good morning. We're counting down. State of the Union is going to be pivotal, but Powell, will he double down, Danny, in terms of delay?
We're Monzo. Give us a go. See? Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo. We can do that. Bingo's my cockapoo. Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Friday talking about there is no bubble, there's no mania, and then Costin comes out over the weekend saying there is limited U.S. stocks with...
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
0.2% on your 10-year yield. This is much below where we started the week last week. Some of it has to do with that poor data we got out on Friday, some disappointment on sentiment and factory data. So 4.19% is where we stand. The bond bulls are out there ready to buy the dip. PIMCO says 4.5% is the new 5% in terms of your buy signal. Meanwhile, gold closed at a record on Friday, again, partially due to that weaker data and the cut bets coming back in, not heavily, but ever so slightly in. Meanwhile, again, just near 2,100 there. Meanwhile, Brent crude takes a bit of a dip. It did trade near the year's highs just moments ago. $83 and about 50 cents is where we stand. OPEC Plus extending their output curbs into the summer. Now, Manus, when it comes to the insatiable...
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Halcyon halo glow for all asset classes.
It's a good question. You know, we've shifted from a narrative where will the US have a landing this year? Will the Fed have to cut because the economy will go into recession? To the question of will the Fed cut, and is it going to be a situation of more growth at more inflation or more growth at less inflation? And it really comes down to this question of, are we all just being surprised here by the fact that the neutral rate is just much higher than we expect? If the Fed decides actually it thinks the neutral rate is, say, 4.5 or even 5, that would be incredible. But still, what it would mean is actually nothing will break. The Fed doesn't have monetary policy quite as tight as we thought. And in fact, what we've seen is just an improvement in the supply side of the US economy, helped to moderate inflation. And during that period, the Fed has just normalized rather than tightened its monetary policy. The market still should be expecting cuts. I've got 4 in for this year, but the risks are now clearly to the upside, and the hope is that nothing will break.
I mean, it's interesting you're talking about the neutral rate being maybe higher than where we thought it was. I know this has long been a discussion, but that in context of the Fed starting the year, having a really strong cutting bias, almost putting verbal cuts into this market the way it reacted, and then slowly starting to pull back. It seems like this is an FOMC that is unsure how restrictive rates are right now. Callum, how do you judge the tightness of current monetary policy?
Well, you know, it's actually very, very hard to come up with a straight answer. It's only, as it always is actually, in fact, when it comes to monetary policy, with the benefit of hindsight, that we know whether monetary policy was set appropriately. I just cast your mind right back to before COVID. The Fed was tightening monetary policy as the economy was producing a little bit more inflation, a little bit more wage growth, and that mainly reflected actually an escape from the long period of ultra low interest rates after the global financial crisis. If we were just to abstract from COVID and abstract from the Russian invasion of Ukraine and all of the global supply side shocks, what we would have found is the Fed would have been gradually lifting interest rates up through this period, and that neutral rate, or R-star as you call it in the US, has been drifting higher. My hunch is R-star is probably around 4, maybe 4.5%, but if we get just blockbuster data through the first half of this year, say real GDP annualized at north of 2%, the risks there are clearly to the upside, and the Fed will be very circumspect in cutting interest rates, because if inflation is coming down and the economy is growing above its estimate of potential, which is around 1.8%, why would you lower interest rates?
Well, I don't think markets have quite grappled with the concept of a neutral rate at 4 or 4.5%. I think very much underpriced. Okay, let's abstract a little bit. I was drawn to what Alfonso Peccatiello put out on LinkedIn and on Twitter over the weekend, and he said this, and this is what we must consider. When will something break in the US is the wrong question. Where will something break elsewhere in the world is the right one. And to that point, Callum, you know, global central banks went in syncopation with the Fed. They may have lagged the Fed on the way up. Here they are. They are under so much more pressure in stagnation nation UK and in recession, tipping recession. You know, it's a tough time in Europe. So if I said to you, well, where else in the world will something break? Where would that be?
It's a good question. The 3 regions we should care about: China, unlikely that something will break. They have huge property and real estate and debt problems, but the institutions will protect the system. So no risk that something really breaks badly there. In Europe, there's virtually no economic growth. We've had big supply side shocks, but actually the banking system is in good shape. Households and businesses have sufficiently strong balance sheets to tolerate this interest rate shock. Actually, the only place where there's a real problem, where you could say that's something I'm nervous about, is the small and medium-sized banks in the US and the commercial real estate sector. But we just know that the Federal Reserve and the authorities have their arms around that. And so we're not in a world like we had pre-global financial crisis where we raise interest rates and something breaks. We're actually in a world where we raise interest rates and we just get this textbook moderation of demand, inflation, and inflation expectations. In a way, what we're learning is we've fixed the problems that caused the global financial crisis, and the world is returning to normal.
I like this world, Callum. This makes me feel comfortable, I hope. Should I?
I'm skeptical. She's comfortable.
Yeah, fair enough. But part of the thing, Callum, is if we are getting this textbook response everywhere, to Manus's point, it is a market that's pricing in synchronicity among the central banks. Is that also right? Again, if the response has been kind of similar and it doesn't really look like anything is going to break, will banks be cutting around the same time?
My hunch will be June will be a big month. I think the ECB, the Fed, and the Bank of England will probably all cut, although the risks are skewed towards probably later in the year. The other thing just to keep in mind here when it comes to this idea of weakness, what do we mean when we say economies are weak? It's true that economies do not grow as quickly as they did in the past. Productivity growth is much weaker. If Europe can manage 1.5%, that's a great year. If the UK can manage 1.5%, if the US can manage 2.5%, this is much lower than before the global financial crisis. So that's weak potential growth. But economies don't have weak immune systems. This is a key point. The balance sheet side of economies is much strengthened over the last 15 years, ex-governments, and hence we're just tolerating these interest rates much better than expected. Question is, are these buffers to shocks, springboards to recovery once we start to see rate cuts?
Can I just, we have 60 seconds left, and I'm drawn to, you've penciled in 5, I mean, maybe I've got it wrong, 5 cuts from the Bank of England. Something bad's got to happen to deliver 5 cuts. You're going for 5 cuts this year from the Bank of England.
Yes, as long as we get back to 2%, which should happen on inflation in Q2 and Q3, the Bank of England will be able to say, we've had almost no growth, actually a little recession last year over the past 2 years. Let's neutralize monetary policy. Neutral for the UK is probably around 3.5%, so they can start to get there over the course of this year, so long as inflation hits that 2%, which we expect.
Let's hope everything goes smoothly with the UK budget with Jeremy Hunt on Wednesday. Callum, we're going to have to end it there. Thank you for joining us. Callum Pickering of Berenberg. Okay, Manis, let's get to some of the other top stories that are trending on the terminal this morning. Congressional leaders have revealed a detailed agreement to keep large parts of the government open and operating through September 30th. The $436 billion package includes provisions to prevent oil sales from the U.S. Strategic Reserve to China and to track foreign purchases of U.S. farmland. But it did sidestep lingering disputes over funding for defense, homeland security, and social programs.
On Saturday, Donald Trump swept 3 more Republican presidential nominating contests. He beat his rival, Nikki Haley, in Missouri, Idaho, and won all of Michigan's remaining delegates. Meanwhile, Haley got her first primary win in D.C. The race now shifts to Super Tuesday tomorrow, when 15 states hold the GOP primaries.
SpaceX and NASA have successfully launched the Falcon 9 rocket, carrying Crew 8 from Kennedy Space Center. The launch is carrying 3 NASA astronauts as well as a Russian cosmonaut to the International Space Station. The new crew will oversee the arrivals of 2 new rocket ships during their 6-month stay.
Spain's largest bank, Santander, is said to have cut roughly 320 jobs in the U.S. A source says 2.7% of the employees are on the retail operations across the U.S. branches, which have been let go in recent days. Santander told Bloomberg it has been updating its staffing model as it invests in digital capabilities to adapt to customer needs. Coming up with Danny and I, we're skipping the Q&A. China scraps Premier Lee's press briefing, breaking a 30-year norm.
And U.S. Vice President Kamala Harris joins calls for an immediate ceasefire in Gaza. We're going to discuss the negotiations over a 6-week pause in fighting. That's to come later in the show here on Bloomberg Brief.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manish Cranny in New York. Now, Premier Lee has decided not to hold a press briefing at the annual parliamentary meetings. It will be the first time in 3 decades that the country's #2 official will not take questions at the National People's Congress.
Considering the above, there will not be a press conference given by the Premier after the conclusion of the second session of the 14th MPC. And barring any special circumstances, this arrangement will continue for the remainder of this term of the MPC.
Joining Manis to me now is Bloomberg's Asia Government and Politics correspondent, Rebecca Chung-Wilkins. Rebecca, this is coming at a time where already China is restricting data. It's an important time for the Premier to speak with the public. So why cancel this?
Yeah, it's a really big decision, and it's quite a surprise. It's taken quite a few investors and people in China by surprise too. I mean, it's an important signal, I think, for how Xi Jinping intends to proceed with his third term, eliminating one of the few channels for a premier, senior official to directly speak about policy making, and also diminishing and reducing the role of what it is to be premier. And part of the reason why this is such a big deal is because how this briefing has been used in the past. And so typically premiers in the past have actually used this to, for example, joke with reporters, to sort of almost make fun a little bit at themselves, to talk about anything from poverty to financial markets to investment, really cover a wide range of topics and be much more candid and human. And so for some people, it really will mark the end of an era that they no longer have this access to the sort of more real side of officialdom in China.
Rebecca, good to see you this morning. This is a country which has just been through some pretty significant control of housing, technology. It's coming out the other side of that. What do they need to reassure investors of? The old-style bazooka stimulus is something that has been consigned to history. It's much more targeted and much more precision-engineered. So what will the markets be looking for in terms of stimulus narrative?
Well, this is one of the big challenges, I think, with cancelling this briefing in the first place, because this is one of the briefings, or this is one of the opportunities where you have a policymaker able to speak directly to some of those concerns in a way that may not be directly addressed in the work report that we expect released from the MPC tomorrow. I think part of the thing that investors will be looking for in terms of how much fiscal stimulus and the narrative around fiscal stimulus is going to be how they discuss this very key GDP target. So it's likely that it's going to be 5%, but we don't know what kind of language policymakers are going to use about that. If they are going to say something like, you know, we will absolutely do this at all costs, if they're going to be really firm about meeting that target, or if they show any kind of flexibility about coming going under it. And of course, anything under 5% is going to disappoint too. Now, if we come in and hard saying that they're going to hit 5% at all costs, we will expect that fiscal stimulus is going to be stepped up, enforced more forcefully and also enforced more swiftly, because we do not have the benefit of that very low base which we had coming into 2023, where it was relatively easy, it appeared, for policymakers to meet that 5.2 target. This year is much more of a challenge, particularly because, of course, we see that property crisis still rolling through. So any kind of measures in terms of property and trying to support the market, that list of the white list of the 50 property developers, that's going to be very, very closely watched too.
Right. Well, we already know that they did their biggest ever cut to one of the key mortgage reference rates. What is there left to do when it comes to housing, Rebecca?
Certainly a challenge. I mean, I think there are two sort of ways to look at this. On the one hand, we will see this nationwide push. Now, we haven't really seen, after that 50 developers on the whitelist, we haven't really seen them go much further than that. One potential is that the state steps in a bigger way to get that going. That could be, for example, through funds, nationwide funds to push state-owned enterprises taking on some of those projects. Could also be in the form of subsidized housing for low-income housing. So there are a few more specified tools. But the other element of this, of course, is going to be just how China actually rolls out these policies. Now, Xi Jinping has emphasized that provincial, local government officials need to take things on individually and not need to sort of just roll things out broad scale without consideration. But implementation is still the big question mark.
Yep, implementation risk is a pervasive theme this year, from policy, macro policy to monetary policy. Rebecca, thank you so much. Rebecca Chung-Wilkins with the very latest from China. Quick snapshot of Bitcoin for you. We traded over the $65,000 level. Danny, this was the first time that we made it above there since November 2021. So again, this is all to do with flow into the ETFs, as well as the overall risk momentum that we have. I mean, there's a pretty stunning fact. We're up like, what, 186% on Bit, 186% in the past 12 months.
Well, also the scary thing is the meme coins like Dogecoin, Shiba Inu, those are also up 20%, 34% in the last 24 hours. So there is this feeling of 2020 repeat with some of these more memey, junky kind of names.
Junky kind of names. Well, some of the more hefty names, Coinbase, Riot Platforms, and Marathon, all trading higher in the pre-market. You can see there you've got Coinbase up, lagging the other two, up over 1%. Keep your digital wallets live. You can now get it in your wealth management package. Good morning from New York. It's Monday morning. We'll risk on in crypto.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? investors, particularly in Europe, more and more place value on what we're doing in sustainability. Many of our partners have expectations on sustainability.
DOJ or other authorities
could face bigger challenges.
Britain was elected. Was going to keep bringing the World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
Tour. She made 93.2 million last October when it opened. So just to put it in context for you, it really was quite a strong opening.
I love you compared it with Taylor Swift. I literally wrote two things about Dune on my page, and it was Dune box office. It's fine. We share facts here. Are you going to go see Dune 2 in theaters?
Only... I have to watch Dune 1 first of all.
You have to watch Dune 1. We'll do a marathon or something.
I feel bad now. I stole her fact.
Here's my other fact. North American movie sales have fallen 18% through Feb 25. So these movies are doing well, but the theaters, not so much.
2 facts in one day.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. Mm-hmm. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
Risk-on momentum continues. Markets count down to Powell's testimony, State of the Union, and the pivotal jobs report.
Meanwhile, oil trades near this year's highs as OPEC Plus agrees to extend supply cuts.
And Vice President Kamala Harris calls for a temporary ceasefire between Israel and Hamas. The talks drag on.
So it's quiet so far this morning. I have written out a list, Manus, of what we've got. A Powell testimony, a China MPC, a UK budget, U.S. payrolls to end the week, and oh yeah, that State of the Union. There's a lot.
It's going to be interesting to see what comes from the State of the Union. And we just had Colin Pickering on. He's calling for 5 rate cuts in the UK and a higher neutral rate of 4 to 4.5%. I don't think these markets are ready for 4.5% in a neutral.
No, we're not trading there now. Where we are trading, let me take you to the markets. We are below 4.2% on your 10-year yield. This is easily below where we started the week last week. Now, one of the things that did drag down yields, a bit of a rally on Friday, was some weaker data coming from consumer sentiment and factory orders. Now, the reverse happens this morning, as it often does on Monday. We are selling, but again, still below 4.2%. The bond bulls are out. They say buy the dip, even though we've had yields drift higher throughout the entirety of the year so far. 4.5% is a new 5%, according to PIMCO, for your buy level. Gold continues to trade higher ever so slightly. It closed at a record on Friday. Again, maybe that weaker data. Meanwhile, Brent crude flips to ever so slightly gains. Manus, I'm pretty sad. That's unchanged. These markets are boring for me this morning, but Brent crude near a record with OPEC Plus extending those output cuts. Please tell me you got something more exciting in equities.
Listen, if you get to Friday and you're still standing there saying you're bored, you know, we're both out of a job. Here we are, equity markets. S&P closed about 5,100 on Friday. There is a synchronicity at Goldman Sachs between David Kostin and Mr. Oppenheimer talking about there is no mania, there is no over-exuberance in these markets, there is no bubble. David Kostin over at Goldman Sachs says there's limited U.S. stocks with extreme valuations. You also then have Bank of America coming in talking about these markets. Bank of America, Ms. Subramaniam says 5,500 by the end of the year. Stronger profits and stronger growth. Keep an eye on Macy's this morning, flying higher. They've got an additional bid from Arkhouse and Brigade, $24 a share, so that's pumping higher this morning, up 13.65%. Taiwan Semiconductor, the highest since 1994, vintage year, of course, for semiconductors in the inauguration of TSMC. It's not exactly playing through at the moment on the NASDAQ 100 and the Nikkei, the highest close that we have seen here. We breached 40,000. It's a big psychological blocker. You've got lots of houses calling a bid for the Nikkei that it can continue further. It's not 1989 redux. Danny.
So we have U.S. equities at a record. We have Nikkei at a record. I think one thing also this market is maybe not grappling with, per Callum Pickering, is this idea that globally, nothing is going to break, that globally everything is okay. I really like what he said, Manus. He said, yes, there are places with weak growth, but not weak immune systems. There are buffers to shocks in place.
And the question is then, are we looking at what he calls a textbook moderation, where all of these sort of quasi-calls about things are going to slow down more aggressively, but that is not his take. We can cope with these higher rates for longer.
And I think a lot of people think that, and that's why there aren't necessarily a lot of hedges in this market. And to that point, Manus, our next guest is preparing for what the market isn't preparing for. He is writing, neither hard landing nor reflation risks are priced, which to us makes long volatility and long dollar positions a cheap hedge or diversifier in a 60-40 portfolio. Joining us now is Jochen Krenmeyer, Senior Portfolio Manager at TradeMasters Asset Management. Jochen, so, okay, market's not preparing for a hard landing nor reflation risks. Can I ask, which of those tail risks do you think is more likely?
Hi, first of all, thanks a lot for having me. It's a pleasure to be in the show. So for us, the risk of a reflation scenario is the one, according to the latest fund manager survey, which only 3% of the market participants were answering to. And what we have seen lately is a stronger inflation, especially in the US, than the consensus was expecting, also driven from the supercore component, but also driven from wage inflation. And that's clearly for us the risk. If we see a second leg of inflation, that would be extremely dangerous for multi-asset portfolios. And therefore, we like to find cheap hedges in that market environment to protect against a positive correlation scenario we have seen in 2022.
That reflation risk is certainly something that we imagine Powell will double down on, or the risk that inflation has not been vanquished. You would adjust the portfolio, I presume then, we asked you in the break, you know, you've got the portfolio adjustment 40, 50, 10, which is an alternative to the classic 60-40. Let's hone in on the 10, because that is a commodity apportionment. Is that part of the reflation and growth narrative?
Yeah, exactly. So we lowered a bit the equity weight, especially using puts and collar structures to protect a bit on the equity side. On the fixed income side, we are still rather constructive on the European part. But the question you were asking, the 10% of commodities, that's the one which could bring us the diversification effect. So on the first side, we have the geopolitical risks, which are not fading away. Secondly, the last year's capex has been extremely low, so that could bring up some pressure on the supply side. And last but not least, we see first indicators out of China, which are pointing rather to the upside, with another fiscal stimulus, and all that together brings the commodity section as a good diversifier on a cheap price to us.
So if you need a diversifier in a 60-40, because of course the whole idea of the thing is that stocks and bonds trade in opposite ways. Of course, that hasn't been true with inflation risk. Is it your estimation then that positive correlation between stocks and bonds continues from here on out?
Yeah, especially if inflation is trading at these levels, so above 3%, above 2.5%, which especially for the US, we are expecting going into 2025 until we reach the 2% target. There will be markets and phases where we have positive correlation between these two asset classes, and that's the point and the risk we are trying to hedge ourselves and to find ways to diversify our portfolios. In this case, using the commodity section, but also we do like the US dollar from a European perspective, because if we see this rate divergence between European rates and US rates, we think the dollar has to catch up.
What about the possibility of no cuts in the United States of America, as suggested as a risk from Apollo's Torsten Schlag? That would, of course, embolden your dollar call and the rate differential narrative, wouldn't it? First of all, agree or disagree that is a real live risk of no cuts 2024?
Yeah, the no-cut scenario is something which is not priced by the markets. So markets are still pricing in 3 to 4 cuts within this year. But if you listen to the latest Fed speakers, so they try to push out a bit further on the rate cut expectation to the summertime. And if we still see core inflation way above 3% and this really strong employment market out of the US, I think there's no need and no rush for the Fed members to cut rates quite early. So I think that's a live risk Torsten Schlag was indicating to.
So what do you do with bonds then? I mean, Manus and I were talking about PIMCO, a lot of different asset managers.
Yeah.
All I can remember is PIMCO at the moment.
EWS,
there we go. Thank you, Manus.
Black, everybody's in there. There's everybody.
Yes, thank you, Manus. Literally, all these asset managers are coming out and saying, buy the dips. Sure, you got burned by being long this bond market to start the year, being long duration, but buy the dips. Jochen, when you see that kind of action, when you see selling, it doesn't sound like you'd be willing to buy the dips. I got to be honest.
Yeah, we would start to buy the dip rather on the European fixed income curves, because there we have a disinflation trend which is very much intact. On the one hand side, we have a supply-driven inflation which should fade away, and the ECB can reach the target already in Q3 of this year. So I think the ECB in that sense can also lead the rate-cutting cycle, and therefore we prefer to buy the dip rather on the European side than on the US side. For speaking for US rates, we would rather take the 4.5 to 5% area to add on our US duration risk. Beside of that, we prefer over there the TIPS yield, which is quite attractive to us, especially at the longer end.
Okay, so you are prepared to be brave. Good. Come back and tell us just how much you've loaded up. Joachim, thank you so much for being our guest this morning. That is Joachim Kremer of Tresides Asset Management. Quick snapshot of the cross assets as we kick into gear this Monday morning. Stocks are down by a 1/10%. There's the bonds flat, Danny, and uninspiring. But you're right, there is that monster article out this morning. PIMCO, DWS, they want to buy these bonds if we return to 4.5%. And T Rowe Price say it's a waiting game and remain patient to add your duration. Patience is a virtue.
I'm so happy your memory is better than mine.
No, it's not. It's written down on these notes under the heading bonds.
I'm glad your preparation is much better than
Everything.
mine in that case. Manus, always saving the day for me. Okay, Manus, coming up, U.S. Vice President Kamala Harris is joining the calls for immediate ceasefire in Gaza. We're going to dig into those negotiations next here on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is Bloomberg Brief. Welcome to the show. I'm Manus Cranny with Danny Berger alongside me in New York. So the US and Israel have essentially agreed a 6-week ceasefire in exchange for vulnerable hostages being held in Gaza. Hamas officials are now heading to Cairo to outline their position. The Vice President of the United States, Kamala Harris, has called for a pause to begin straight away.
Given the immense scale of suffering in Gaza, there must be an immediate ceasefire. For at least the next 6 weeks, which is what is currently on the table.
Rosalind Matheson is our Bloomberg EMEA News Director. She joins us now. Ros, the US making very, very clear noises about a ceasefire. The question is, Hamas are on their way to Egypt. Will Israel attend? Will they agree? Have they really signed on to a ceasefire? Good morning.
Well, it sounds like there's certainly the intent, hopefully, to get to something on the part of the US, Qatar, Egypt, and others that have been urging this for weeks. But what we know is that Israel has deferred sending a delegation to Cairo for these talks. They're holding off for now. They're saying they want some clarity first from Hamas on some of what you call the pre-terms, almost, for the terms for a ceasefire, and that is that they want Hamas to agree to give them the details of the remaining hostages being held inside Gaza. They want their names, they want their whereabouts, and they want their health status also. And they want that kind of agreed in a way before they even get to the conversation about signing on to a ceasefire. So it seems like we're several steps away, at least, from getting that agreement. We know that, Israel has drawn up this broad agreement, with the US and the others helping, but Hamas has yet to sign on to it either, and they're traveling to Cairo to discuss it and possibly put their own changes on the table. So we've been here before in some ways with progress towards a ceasefire, and then it falls apart. So really, we're not going to be there until we actually get an agreement on the table that everyone's going to sign.
What difference does it make that we have Benny Gantz, who is more moderate, more popular than Netanyahu, who joined the unity government as part of the Israel war cabinet? What difference does it make that he is now headed to Washington to meet with Vice President Kamala Harris? What can actually be gained from this?
Well, it's interesting that it's Benny Gantz who's going because, of course, he's much more of a centrist politician in Israel than Prime Minister Benjamin Netanyahu. In fact, they've been political opponents many times over the years, but right now they're part of that war cabinet together. And it might be that the US is hoping that they can, lean on Benny Gantz as part of his role in the war cabinet to help convince Benjamin Netanyahu to hold off on an offensive in Rafah. That's that bunched up area near the border of Gaza with Egypt, where a lot of Palestinians are now collected and congregated. And big questions, if Israel does start an offensive, where do these people go? So what they're probably going to do is trying to get Benny Gantz to push Netanyahu further to hold off on that offensive, because as part of the conditions for the war cabinet, all those members have to agree to sign off on that offensive starting.
Yeah, and of course his arrival in the United States has irked Netanyahu, we understand, quite considerably, attending it and almost lobbying in the political manner against Gantz being here and carrying out some of those discussions. Let's talk about action on the ground. The US and Jordan carrying out airdrops of aid into Gaza. Do we sense that this is a display of impatience by the United States of America with Israel?
Well, it's interesting because we had Jordan carrying out these airdrops for some time, using planes to drop food and other essentials into Gaza itself. And some of those airdrops, of course, have gone awry. Some have landed in the sea. Parachutes have not opened. So only some of it is even getting through. But the fact the US has now taken that decision to do the airdrops itself, to join that effort, is really a signal also to Israel of the level of concern in the US about the humanitarian situation inside Gaza, how terrible it is for the people who are living there, their conditions in terms of their access to food, to medicine, and so on. And the US is saying, well, we're so concerned, we're just going to fly our planes over ourselves and drop that aid. Of course, the question is, does that aid do very much on the ground? It does not substitute for the need for hundreds of trucks to go through every day to distribute aid, but at least, if anything, it's a political statement to Israel of that rising level of US frustration.
Roz, appreciate it. Bloomberg's Roz Matheson there. All right, now let's turn to oil. Prices are steady. They are around the highest level this year. OPEC Plus has extended its output curves until the end of next quarter. For more on this, let's bring in Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, this did remove a significant tail risk, the fact that they are extending those output curves. So why am I looking at a basically unchanged oil price this morning?
Yes, I think that we might well have seen a tick higher, but I think the context is that oil had enjoyed a very strong run last week to the highest this year, as you say, Danny. So there is that prevailing sense in the market that the story is a fairly constructive one, that prices have gained this year above 80, just under there now, as we're seeing on the screen, but above 80 in the US, and this decision had been pretty well trailed, so I don't think it was an enormous surprise at the headline level to the market that they decided to roll over these cuts.
Will, good to see you. Russia, the language around Russia, the part of the OPEC Plus, the most significant portion of OPEC Plus in terms of what they're doing. There's always been this discussion around how much is Russia actually cutting of crude and condensates and exports. Talk us through the language around Russia's participation and how significant that is to this extension.
Yes, that was the most surprising thing about yesterday's statement. Russia, which had, when it comes to the voluntary extra cuts agreed by some OPEC Plus members last year, had applied those cuts to exports of oil and products rather than production, will over the next 3 months shift those cuts from exports towards production. Now that is probably a fairly bullish shift. I think the Saudi Arabians will be pleased about it. When we spoke to the minister, Prince Abdulaziz bin Salman, at the end of last year, he said, we're glad that Russia's taking part, but we would rather they did production than export. So it's a shift that he'll be happy with. I think the market will want to see them follow through, though. It's taken Russia a long time to meet its existing obligations. It's doing that now, but it took a lot longer than it was supposed to. And over the last few years, they don't always hit the mark as often as their partners would like them to. So I think the proof will be in the pudding here. But if they do follow through, it's a potentially bullish development that will take up to 500,000 barrels a day out of the global oil system in June.
So on paper, we have roughly about 2 million barrels a day. And as you say, that will happen until June. So what happens after June, Will?
That's the really important question here. I mean, at the moment, the language around those voluntary cuts is that they will roll off gradually, but the market is going to be very focused about what gradually means, when it will happen, how quickly it will happen. I think it will be hard, given that the market seems to be in fairly good shape, that demand seems to be fairly robust in key markets around the world. Question marks over China, of course, but in Europe and especially America, things look pretty good. So I think a lot of Saudi Arabia's allies in OPEC will ask to be able to bring a little bit more oil into the market in the second half of the year. And it's going to be really very important and interesting to watch how those discussions develop in the coming weeks.
Well, certainly a lot of them have that capacity, and there has been that disgruntlement from some of the African nations in terms of the load that they were taking to bear. Let's see, Danny's impatient to know what happens after June. Let's just get through today, the first trading day, post the 2 million barrels cut. Well, thank you, as ever, for being with us, Will Kennedy. We'll give you a quick snapshot of commodities. Danny's bang on the money. There's not much happening in that crude market, despite the extension of 2 million barrels a day. And the Saudis need, Danny, from a fiscal point of view, Riyadh needs $90 a barrel, but they're not going to go head-to-head with the shale. That seems to be the takeaway as well in terms of the cuts and price war.
Right, certainly. And I should say, we don't have it up there, but gold, slightly higher this morning. It closed at a record on Friday. So maybe, some Haven gold bullion, maybe some appetite is back for that. Okay, Mana's coming up. We're going to take a look at some of the market moving events for you to watch throughout the week. If you're impatient like me, we'll set you up for it.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife.
You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. All right, let's get you set up for your trading week. Here's a look at what's ahead. We're going to have more than a dozen states holding Republican and Democratic primaries on Super Tuesday. Then Fed Chair Jay Powell testifies before the House Financial Services Committee on Wednesday and Thursday. Then President Biden delivers a State of the Union address on Thursday night. Manis, we might get a pitch for higher taxes, for corporations, for individuals. So if you want to trade on another potential Biden presidency, there is plenty of opportunity for you to do that.
I mean, this is going to be one long presidential race for sure, and it's going to be a redux of Trump-Biden seems to be the consensus. A couple of stocks, we've mentioned them to you through the morning. Macy's, we've been saying that to you. Investors raising their bid by 14% after there was an earlier rebuff on that. So we're nicely bid up on that, up 15.49% at the moment. Big plans. The Taiwan Semiconductors, again, I said to you, this may well carry through into the chip sector, certainly in Europe and here in the United States of America. Record high on AI optimism and the global chip rally. And then Bitcoin, of course, is rallying. Danny, we've got some facts of the day on that. Coinbase up 6.24%. And it's all about the flow show into Bitcoin.
It is. Year to date, $7.7 billion have gone into Bitcoin funds. That already exceeds, Manis, the $5.2 billion bubble inflow of 2021. Of course, a lot of that has to do with new ETFs. But are we on bubble watch again? Maybe.
Yeah, well, in equities, Goldman Sachs, and I believe Goldman's tell us there is no mania. There is no need to worry. Surveillance is up next.
No need to worry. They'll take it from here.
operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think we have another troubling inflation report that's going to come in March.
Enough people out there are spending that it creates inflationary pressure for everyone.
We're out of the world where inflation stays in that 2% lane.
Inflation falling to target is currently underappreciated by markets.
Inflation is still slowing, and I think it's probably slowing more than the consensus thinks.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P 500 negative by 0.1%. Deutsche Bank's Jim Reed, the run of a lifetime. 16 positive weeks out of 18 for the first time since 1971. It is going to be a long, long road to Friday, 8:31 Eastern Time. Bramo, we've got a double dose of Chairman Powell. We've got a State of the Union from the President and a payrolls report this Friday.
So I was thinking about this. Which is the most important aspect of all of these? Because it's really a blockbuster week across the politics, across the monetary policy, and across economic activity. And ultimately, I think it's got to come down to the jobs report. As much as there's so much comes out before that, ultimately it's going to come down to whether the economy continues to grow at the pace that people expect.
The ultimate question, I think, for this week is whether February confirms January. And if it does, we've already had a big repricing at the front end of the curve. What does it mean for this Fed? And ultimately, what does it mean for this market?
Just to put that into perspective, what we are seeing is the market pricing out only a 25 basis point rate cut or less than that by June for the first time since October. We have not seen this type of lack of rate cuts being priced into the market since going back to late last year, yet markets aren't really alarmed about that. And that's what I think is the disconnect, because maybe people think they're just pushing it back. They're not deferring them indefinitely.
Another all-time high on the S&P 500 Friday at the close. We begin another week at record highs this Monday morning. AMH, we're looking ahead to Thursday night, 8 p.m. Eastern Time. The president, the political spin, he needs to find a new way to connect with this electorate.
It's not even so much, Jonathan, about what he says, it's how he says it. Because over the weekend, there was a number of polls, and the New York Times one shows that a majority of his own voters who voted for him in 2020 are really starting to get concerned about the president's age. What he's going to say, we know he's going to talk about his legislative wins, the CHIPS Act, Inflation Reduction Act, the Hard Infrastructure Act, abortion, all of these things. But it's really going to be how he says it. And if there's potentially any discussions with those House members, like there was at the last State of the Union, does he come off as someone who's strong and combative and can take down Donald Trump?
That's the final point. I think that's the most important one. Whether the president can get through a 60-minute address, that's how low the bar seems to be in some corners of Washington right now, Bramo. Can he get through a 60-minute address?
With projecting strength. I mean, right, it's sort of, if you start fading out toward the end, that's going to be pretty brutal. I think people are looking for strength. They're looking for resilience. They're looking for some sort of cohesion in the messaging, not just sort of trying to cater to one group and then another and everyone trying to placate. But to me, the Wall Street Journal did have a poll that indicated that people do feel better about the economy. Not that much, but, you know, on the margins, kind of shifting a little bit.
But they're not always giving the credit to the to the current president, because in all of the polls over the weekend, whether it was Fox, Wall Street Journal, New York Times, our recent poll in the swing state, they continuously show that Trump is leading him.
Personally, on Thursday night, I'm looking for a sneak peek at a payrolls report Friday morning, given the president may well know the outcome of that particular payrolls report.
You think he's going to release it? He's going to be like, I'm not saying
he will. I'm just saying,
you know,
personally, I'd like a sneak peek at a payrolls report on Friday.
Okay, Joe Biden, if you're listening, Mr. President, if you want to just say, you know, 250.
I'm pretty sure the president's still in bed. Anyway, let's pick out a single name right now. Macy's right now, getting a big offer. Arkhouse and Brigade going up to $24, up from $21. 33% premium to Friday's closing price. Lisa, this stock is up by 15% in the pre-market.
So Macy's didn't like the first offer. Hey, here's $1 billion more. Will you reconsider? My question is, what do they want with Macy's? Do they want the real estate? Do they want the retail business? How are they going to divvy it up and extract value from a company that did just come out and talk about scaling back some of their Macy's chains, but also scale up some of their higher cost brands?
The stock is up by something like 15%. We'll keep an eye on that through the morning. Let's start the morning with some price action for you. On the S&P 500, we're negative by 0.1%. We're pulling back just a touch here, Bramo. Yields are higher by a couple of basis points. Your 10-year, 420.
So let's just go over how big of a week this really is. On Tuesday, of course, we get Super Tuesday. 15 states and 1 territory do vote. We do get maybe the send-off for a Trump versus Biden rematch, which everyone's very excited about. On Wednesday, we get the JOLTS job openings. Powell is testifying in front of the House, which I know that you guys are going to be really interested in all the searing questions that are not at all some of the punditry that we normally get in these. On Thursday, we get another testifying from Jay Powell in front of the Senate Banking Committee, and then non-farm payrolls on Friday. Again, non-farm payrolls, to me, arguably the most important after that State of the Union, because ultimately it will come down to whether people do feel that there is some sort of energy behind this market or whether it's overheating.
The estimate just sort of creeping higher over the last week. The median estimate in our survey, something like 200K. That's the week ahead. Here's the next hour or so on this program. Laurie Calvasina of RBC Capital Markets with Wall Street boosting S&P 500 targets. Terry Haynes of Pangea Policy ahead of Super Tuesday and Biden's State of the Union address later this week. And Sheila Kaiolu of Jefferies as Boeing looks to buy its most important parts provider. We begin with our top story. All-time highs on the S&P 500 driving some big revisions on Wall Street. Bank of America's Savita Subramaniam, the latest, raising her target to 5,400 from 5,000. And Laurie Calvasina of RBC saying there's more room to run. Writing this, quote, we are still constructive on the stock market with a price target of 5150. Our most constructive model has been pointing to 54 and 5,500. Laurie, I'm pleased to say, joins us around the table. Laurie, good morning to you.
Good morning. Thanks for having me.
Let's get straight into the reasons to be bullish right now. What's the big one?
So the big one's coming from our valuation model, which is saying if inflation continues to moderate and we get a little bit of interest rate relief, the multiple can be higher than many people assume. That's been a very controversial discussion that we've had. I'll tell you the other model that we have that's starting to shift is our economic model. Typically 0 to 2% is a weak range in terms of GDP for the stock market. That's what we've currently got baked into the 5150. But if you look on Bloomberg and look at where the consensus is, it's moved up from 1.6% mid-February to 2% now. So the economic excitement that's coming out, I think, is another reason to get excited about stocks now.
It's funny that you went to multiples first, and I imagine the pushback you get is because a lot of people that have come on this program, even those who have upgraded stocks, they're bullish on the earnings. They often don't talk about bigger multiples expanding. Where does that come from?
So, you know, it's funny. It comes from the summer of 2022, and I was building a new valuation model, and I had a lot of clients who frankly said to me, you know, if inflation is X and interest rates are Y, what should the PE be? And I said, oh, I have a little model that shows this. You know, it's more of a compass than a GPS, but it tells you can argue for, you know, multiples in the low 20s on a trailing basis, right, not a forward basis. And people thought that was interesting. Eventually, people said, what happens if you flex GDP assumptions? So we threw GDP into the model. And we actually found that if you look post-COVID, GDP is having a positive correlation with PE multiples. We haven't seen that in every decade. Our model goes back to the 60s, but there have been certain decades like the 80s and 90s where that did exist. So we think the things that are driving PEs are changing, and it's a very, very different dynamic than what we saw post-GFC. I think a lot of people are looking at post-GFC rules of the road. And that's really just kind of outdated, to be honest.
So David Kostin said the 4 most dangerous words in finance over the weekend, basically coming out and saying this time is different, and that people who are worried about some sort of bubble in the Magnificent Seven are getting ahead of themselves, that there is more room to run. Do you agree that this time is different, that the 16 out of 18 weeks of gains for the first time since 1971 is not a warning flag, but actually a sign to keep going?
So look, I've gone back and looked at this concentration issue every which way I can think about it. And if you just look at concentration spikes in the market, when the market cap representation of the biggest 5 or 10 stocks swells to a certain level, it doesn't give you a signal about anything. It just tells you that you're in a period where people either are about to be or have been nervous. We've been nervous for the last 4 years, right? So I don't think it's telling us anything except that nervousness is still out there in the market right now. What we do see is if you look at it from a PE perspective, the top 10 or the top 5 stocks are getting to levels that have marked peaks in the recent past, but the rest of the market still has a lot of room to run. And I think one of the things that's going to fuel rotation in the market away from those big stocks back to everything else is this idea that GDP expectations continue to improve, which should narrow the earnings advantage of those big names. I think they've done well for good reasons. Their time may be running out, but that doesn't mean they go down.
Savita Subramanian of Bank of America did come out. She upgraded her forecast to 5,400, talking about a 5% upward gain from here. You have a 5,150 target on the S&P for year end. You have a range that sort of looks at 54, 5,500. Why have you not upgraded just yet?
So look, the thing we've been saying really since January or even in late December is that we thought this market needed to see a bit of a pullback. If you look at the AAII data or the CFTC data, it's really quite concerning. The AAII net bulls are basically hovering between 1 and 2 standard deviations above the long-term average. And typically you get a flat market over the next 3 months when that's happening and sort of, 6.5% type gains over the next 12. So it's not a, sort of panic signal, but it is a short-term caution signal. CFTC is actually a bit more concerning. NASDAQ futures positioning is hitting new highs, so it's as crowded as it's ever been. And on the broader U.S. equity market futures positioning, if you just look at the buy side in aggregate, we're above the highs that we've seen pre-COVID. We're above the highs that we saw in early 2018, and we're well above the highs that we've seen in 2021 through 2022. So I do think we've got to see some volatility in this market at some point. I think we're going to be higher by the end of the year, but it may not be an easy path.
When you see volatility, you mean pullbacks?
Yes.
5% pullbacks?
It's a funny question, John, because I keep getting asked, how big is this going to be? And I said, look, it can't be more than 10 because more than 10 is a growth scare. I think the economy, we're in the middle of ratcheting up expectations. If you're looking at that 5 to 10% range, maybe it is more like 5 than 10 because everybody wants the dip. And when I show people this sentiment work, they're very sympathetic to the idea that maybe the market's gotten a little bit ahead of itself. But when that happens, the dips do tend to be shallow.
I was struck by Citigroup credit card spending data that actually shows a reacceleration in people spending in the month of February. People keep talking about how we're going to get a deceleration. The indicators on the peripheries don't seem to suggest that. How do the people who you speak to, your clients, feel about where things are right now?
So, it's a very different conversation than back in August. So back in August, we were in the middle of starting to see interest rates move up. There were a lot of doubts over the Fed, and it was, oh my God, the Fed is going to tighten us into a recession. That's not the case now. Now it's, oh my gosh, the U.S. economy is so hot, we're never going to see cuts. And the emphasis is on the economy is so hot. And I think there's a begrudging acceptance in the investment community. I saw this in Europe a couple weeks ago. I saw this in the U.S. in my marketing last week, that this economy is really not nearly as fragile as people think. This is something we tend to see post-crisis. We saw it in 2002, 2003, and 2010, 2011, where there was constant fear of tipping into a recession that never happened. I've been starting to describe this as investment community PTSD, and there's a lot of sympathy for that. I mean, I think a lot of people who have been around for those periods in the market remember that, and they're like, when I point it out, they're like, yeah, you may be right. What do you think of the likes of Torsten Slok saying potentially no rate cuts this year? So I talked to my rate strategy team about this last week because I did have a few meetings where that was thrown out there, I think even before Torsten, sort of put that note out. And I've heard this in a few corners, and I give our rates team a lot of credit. They were never in the March camp. They've always been in the June camp. They've been making that call since last summer. And when I kind of pushed them on this late last week, they said, look, we do think these cuts were always about preventing a downturn, not, sort of arresting one in the middle of it happening. And so they do think the Fed is going to try to come out and, sort of defend sort of the employment side of the mandate and really try to keep the economy from going to a bad place. And I think that's right. They've also talked a lot about adjustment cuts. So as inflation moderates, do you want to be incrementally tightening from here? That's been their view for a long time, and they're sticking with that.
Torsten Slok, Apollo, by the way, 7:45 Eastern time, so about an hour, 30 minutes from now. on this program, breaking down that big call. Laurie, good to see you. Going to be sticking with us. Laurie Cavazzini there of RBC Capital Markets. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China's Premier Li Qiang won't hold a press briefing at the country's annual parliamentary meetings. It's the first time in 30 years that China's #2 official will not take questions at the end of the annual National People's Congress. The move scraps one of the few events on China's political calendar where a top leader interacts with the public. Congressional leaders have revealed the detailed agreement to keep large parts of the government operating through September 30th. The $436 billion package includes provisions to prevent oil sales from the U.S. Strategic Reserve to China and to track foreign purchases of U.S. farmland. But it sidesteps lingering disputes over funding for defense, homeland security, and social programs. SpaceX successfully launched the Falcon 9 rocket from NASA's Kennedy Space Center in Florida on Sunday. On board, there were 3 NASA astronauts, a Russian cosmonaut heading to the International Space Station. The spacecraft is scheduled to dock with the ISS early Tuesday morning Eastern Time. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, a massive week on Capitol Hill and Nikki Haley refusing to back down.
You did sign a pledge, an RNC pledge, to support the eventual nominee. Do you still feel bound by that pledge?
I think I'll make what decision I want to make, but that's not something I'm thinking about.
That conversation is coming up next, live from New York City this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's a huge week in politics. Tomorrow, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Keely Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
Stocks on the S&P 500 here a little bit softer. We're negative by 0.2% on the S&P. Yields a touch higher by 2 basis points. Your 10-year, 420.33. Under surveillance this morning, a massive week on Capitol Hill, and Nikki Haley refusing to back down.
You did sign a pledge, an RNC pledge, to support the eventual nominee. Do you still feel bound by that pledge?
At the time of the debate, we had to take it to where would you support the nominee, and you had to, in order to get on that debate stage, you said yes. The RNC is now not the same RNC. Now it's
So you're no
Trump's
longer bound
daughter-in-law.
by that pledge?
No, I think I'll make what decision I want to make, but that's not something I'm thinking about.
It's the latest this morning. Voters heading to the polls in 16 states tomorrow for Super Tuesday. We get a double dose of Fed Chair Jay Powell on the Hill Wednesday, Thursday, and President Biden delivering his State of the Union address Thursday evening. Joining us to discuss is Terry Haynes, founder of Pangea Policy. Thursday evening, 8:30, 8 p.m. When we hear from the president, Terry, who does he need to speak to in this economy, in this country?
Well, he needs to speak to everyone, of course, but fundamentally he needs to speak to people who are unconvinced that he's up to the job and people who are unconvinced that he's done a good job. Those are the people he needs to focus on. He needs to treat this thing, and I think he will, not only as a de facto campaign speech, but to show that he's on top of the game and on top of the issues.
The Washington Post this morning has an opinion piece that says, give him hell, Joe, and keep the State of the Union shorter. They say he needs to become like Truman in terms of trying to stick it to Congress and blaming Congress. But he said Biden spoke for 73 minutes last year and what he called an inflection point in history. It is far less important for Biden to be comprehensive than it is to be compelling. Do you agree? Does he need to keep this short so he can keep up his stamina for this speech?
Well, I think he needs to be focused fundamentally. There is that stamina component, and I think that's fundamental both politically and to markets. So, the strength of and the certainty of the U.S. government underpins markets in ways I think they haven't thought about in quite some time. But yeah, the laundry list approach of this speech, which reached its apogee, I think, during the Bill Clinton days, and has never really gone away, absolutely needs to go. What voters need to hear, what citizens need to hear, is something shorter, punchier, and more focused on what the speech is supposed to be, the State of the Union, and a little less about whatever the laundry list of the government is supposed to be.
Terry, we had a lot of polls over the weekend. Fox News, New York Times, Wall Street Journal. Dismal figures still for the sitting president. Should the Democrats start to be more worried than they already are?
Well, if you got the New York Times leading with saying, it's time for bedwetting, where the political center is on a lot of this stuff. I think Biden's people will do what they did in 2020, which is to get out the vote and not take any of those votes for granted, number one. But no, I don't agree that it's time for panic. My view on this for quite some time now has been that you see weakness in Trump and you see a third party challenge that hasn't quite gelled yet. Trump's weakness really comes down to, his base is still there, but his base isn't by no means everything. What he really needs is he needs a party unifier, which he's not going to get, and independence, which he's also not going to get. So there's very much a path still here for the president if he wants to take it and again, not take any of those votes for granted.
Terry, what do you make of Kamala Harris coming out and taking a harder line with respect to a proposed ceasefire between Israel and Gaza, Hamas? How much do you see this as sort of the new role that she's going to try to take up?
Well, I've said for quite a while now that I think people ignore Vice President Harris at their peril. She's very unpopular, generally speaking. Her gaffes and whatnot are well known in the political class. But at the same time, she's got constituency, and there are places in the Biden constituency that she can speak to and be very effective. And one place there, frankly, is in a situation like Israel-Gaza, where the Biden people are trying to speak to the Palestinian community in the United States and abroad. And so her being out there on that stage has the possibility of being very effective for the administration.
And Terry, can I just ask your thoughts on the future of Kamala Harris? She's young, certainly very young, compared to the president, with a lot of runway for her career still left. How does she avoid becoming, say, the next Mike Pence with no political future if the president doesn't win this election?
what she needs to do, firstly, if the president doesn't win this election, firstly, she needs to be seen as an effective partner in the election effort, firstly. Secondly, she needs to be seen as someone that did not contribute to that election defeat, assuming that that's where we are. But thirdly, she's still well thought of by the progressive wing of the party. That's where the energy is, that's where the money is, and she can continue to be a player there. She's going to have to get over the speed bump she's created in her career as vice president to do that, but an effective campaign performance can go a long way there.
Terry, appreciate your time, sir. As always, kicking off the week there with Terry Haynes of Pangea Policy on the week ahead in Washington, D.C. Laurie Cavacina of RBC still with us. Laurie, I've quoted you about 1 million times already this year, and it's regarding politics, and it's your quote where talking to clients seems to be like staring at the sun when it comes to politics down in Washington. Has it got better?
It's gotten a little bit better. I mean, you know, I think my colleague Amy Silverman put it this way. She said there was sort of a begrudging willingness over the past week to look at this issue a little bit more than the past. And I think that's right. I would still say investors are squinting pretty hard, and it's still pretty painful. You know, we'll see what my call volume is like later this week, but after both Iowa and New Hampshire, those were the questions I was dealing with. And I talked to one investor, and the way he put it was, I got burned by Trump in 2016, didn't pay enough attention, so I've got to look at this now. And I don't think U.S.-based investors are doing a whole lot right now. I'm getting requests for what does the historical playbook look like around elections? What did well when Trump won? Small caps are coming up a lot right now because back in 2016, they were a Trump trade. They were another Trump trade in 2018 on the trade war. So whether you think we're going to have, you know, sort of a Republican administration that, you know, really cuts taxes, reinvigorates the consumer, or we have a more isolationist foreign policy, both of those seem like buy America trades, and small caps line up nicely with that. So we're having conversations like that, but to be honest, John, there's just not a lot to do right now because there's nothing but breadcrumbs to analyze.
Well, but that's exactly the reason why. In some ways, I'm more interested in the jobs report. You said you might be more interested in the State of the Union in terms of a market-moving and interesting kind of event. How so, from a market's perspective?
I think it's more hope that I'll have something other than breadcrumbs to analyze at the end of the week. You know, I feel like I've been educating a lot of European and Canadian investors about social issues driving our elections, which is interesting and matters to the turnout and who will ultimately win. But ultimately, there's not a lot to invest around on that. So I think I'm just hoping my job will be a little bit easier at the end of the week.
I think we're all trying to work through the breadcrumbs. Brammer, the question I've been asking, I think you've asked it as well, is whether the Trump trade is different this time around, how different it might be.
If the protectionism comes out before some of the fiscal boons, because frankly, there just isn't that much room given how deep the deficit is and how much pushback we've heard from his Republican Party.
Last time around, it was tax cuts, then it was tariffs, and you just get a feeling that this time around it might be tariffs up front.
And that's going to have a very different effect when he's talking about 60% tariff on China, when he's talking about keeping things in America. You wonder whether he will go through with it in the same kind of way, and whether he'll be that much more so, given that it is his last, it would be his last term.
Laurie, it's going to get better as the year grows older, I promise.
I hope so.
I hope so too. Laurie Cavacina of RBC. I mean, that was more hope from me than it was conviction. Equity futures right now on the S&P 500, negative here by 0.2%. Coming up next on this program, Sheila Kahyaoglu of Jefferies on Boeing's bid for Spirit Aerosystems. That conversation just around the corner. A monster week still ahead. A double dose of Chairman Powell and a big payrolls report on Friday. Live from New York City, this is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Two days of gains on the S&P 500, two-week winning streak as we kick things off this Monday morning, pulling back just a touch. We're down by 0.2% on the S&P, on the Nasdaq down by 0.1%, 15 all-time highs this year already on the S&P 500, and tons of upgrades over the last week too. In the bond market, we look like this. The two-year yield falling back for 4 consecutive days into Monday. A little bit higher this morning by a couple of basis points, 455. Think about where we were a week ago. We closed above 470 for the first time this year. Lisa, we're back down to 455 a week later.
And just because we got some weaker than expected reports, that when you look under the hood on Friday, people were saying they're not as weak as they seem. But even after the hot CPI and PPI, a hot everything else, and the hot labor market report, and the hot everything, this is what people cling to because they want the soft landing, and that's basically what they're honing in on.
A second week of dollar weakness as well. Let's push that through foreign exchange. Actually, last week as well on the Japanese yen, I think that was the first week of yen strength so far this year. It was really, really marginal, Bramo, but it was there off the back, and maybe we get some action sometime soon.
Given the fact that there was some discussion that maybe hinted at some sense that they're getting closer to their 2% target, I have to say Japan is fascinating because people talk about the flood of cash into their equity markets and how much is this a boon and how much is this just simply, they've been kind of going nowhere since 1989 until now.
Yes.
They're sort of kind of waking up from the slumber.
Going to come back to that point in just a moment. I think it's really, really important. Just to finish on the euro, 108.55 on that currency pair. I know this is not exactly value add, but doesn't it feel strange the ECB is Thursday? It doesn't feel right.
You mean because
something sort of not right about
cares?
that? It's like a 2-week gap between them and the Federal Reserve, which just feels a bit off.
You think that it should be the day after? It should be like bang, bang.
Yeah,
bang, bang.
Absolutely, like back to back, compare and contrast. I don't know about the thing, but sure, back to back is helpful. Under surveillance this morning, our top stories: Vice President Kamala Harris now calling for a temporary ceasefire between Israel and Hamas. Talks are planned between delegations in Cairo, but Israel is not expected to send representation without certain information from Hamas. Today, Israel's Benny Gantz, a member of the country's war cabinet, will visit with Harris at the White House. The news comes after US and Jordanian forces have started operations to airdrop aid into Gaza. Anne-Marie, I'm trying to work out if this is just a natural evolution, further progress in the administration's position, or whether this is Kamala Harris putting some distance between herself and the president.
I think what this is the administration trying to put some distance between themselves and Netanyahu and trying to ratchet up that pressure as they know they're going into these talks for a ceasefire. And we do know that Israel decided not to send a delegation. Although over the weekend, U.S. officials had said there is something on the table if Hamas agrees to send back the hostages. The most important thing you read, Jonathan, in that was that Benny Gantz is going to be in Washington. Israeli media, local media, is talking about how Netanyahu is fuming about this. And in a tense phone call he had with him before this trip to Washington he's making, he said, just remember, there's one prime minister in Israel.
I saw the same reporting as well. Lisa mentioned Japan. I want to turn to that just briefly. The equity rally gaining some big-time momentum over in Japan. We've got the Nikkei 225 surpassing 40K for the first time ever. Foreign investors bringing funds back to the market after posting net outflows for 6 of the last 8 years. Bloomberg also reporting the government is on the verge of calling calling the end to deflation. Some big changes potentially over there. Expectations are growing. The BOJ will hike rates in the coming months. The next BOJ decision is March 19th. So 40K, line in the sand, you can draw it all the way back to the late 1980s. That was the last time we threatened to go through 40K. We're through it today. I wonder what the takeaway is for you here, Lisa, but here's the takeaway for me ultimately, that it took this long. That for the buy equities, they only go up crowd, that there is evidence that you can have lost decades in equity markets. You can just look abroad for them. You'll find them in Japan.
And that now we're catching up and people are saying, flood the markets, get back in. Is this some sort of rip-roaring surge that people are going to try to sell out of? Or is this just basically re-embracing Japan as a global market? Basically saying, look, we're finally seeing growth again. We're finally seeing cross-border investment, unlike what we've seen before. Because how many of the companies, yes, are hinged to this lack of deflation suddenly, but also to the U.S. government, right? And to the U.S. economy in a new kind of way.
It's a policy effort that is decades in the making, potentially calling the end to deflation. That stock market, by the way, year to date, up 20% on the Nikkei 225, positive by 20% over the last year, which is just absolutely amazing. Let's turn to a big mover in the pre-market. It's Macy's. Investors raising their bid for Macy's after being rejected in January. Ark House Management and Brigade Capital Management are offering 14% more. The increase coming at $24 per share. That's a premium of a 33%.